Okay, so one of the very first ones that you had learnt was obviously the RSMT. So I'm going to just quickly show you something like that, and then we're going to say that over here we get our SMT over there because the corresponding asset over here has made a higher low, which would be, for example, the DXY versus, say, GU. So over here we have the DXY, and over here we have GU, or the foreign asset over here. And then this is SMT, and then obviously based off of this SMT, we are likely to get some kind of up close candle over here, like this, somewhere there. And then preceding that, we are going to get some kind of expansion because they sold into the up move. They took the high of this liquidity and then price sold. So we got an old high over here. We've got an order block and we have got a void. And then when price would eventually return back over here, this would be a return to SMT. So this would be RSMT, like that. Okay, and RSMT doesn't have to be the closure of the void. RSMT simply just means that it is returning back to the SMT, meaning it could return back to closing the void. It could return back to close the, or retest the order block. It could also come back and even again take out this high over here. We don't know which of the three institutional reference points of this RSMT structure here will be retested. All that we want is that if this is SMT first initially, and now price is returning to the SMT, we just want, when price gets into one of the three reference points, to create a new SMT. And that new SMT could really be on any time frame, preferably the time frame that you use to identify the initial SMT void, order block, and expansion away from that area. So if this was a 1 hour chart, you'd be anticipating that there should be some kind of 1 hour new price action SMT to be created at that zone over here, like that, and then boom, price sells. So you'd be wanting some kind of SMT somewhere in one of these three institutional reference points over here, and that is simply RSMT. I have taught this to you guys, so I'm not going to, bore you with more of this repetition. But if
Please
anyone,
have a doubt.
sure, go ahead.
Okay, I go step by step. So the first SMT, right?
This one over
So
here, yes. I'm just going to label
yeah,
it as number one over here, yeah.
okay. So this SMT, um, so is this SMT has to be on a higher time frame?
So the initial SMT doesn't, it can be of a time frame that you're going to use to, identify some kind of trend, right? So maybe like a 4 hour, a 1 hour. Obviously, there's going to be some kind of requirement for price to want to sell from there, right? So you can't just randomly say, okay, well, there's a 15-minute SMT, price is going to RSMT, and then I'm going to wait for a new SMT at the zone. What's there at that zone? Is there like a daily order block? Is there a 4 hour void? There must be some kind of reason, still confirmation as to why we would enter that trade. Still, always. So maybe that's like a monthly SIBI. Maybe it's a weekly order block, or maybe it's a, I don't know, daily rejection block. I don't know. It could be any one of those PDAs, but there must be some kind of element of reasoning behind the trade, not just because all of this here is just SMT, right? It's not like there's confirmation here. So this is just the element of entry we are looking at, RSMT, and still you need your confirmation Thiva. So you can't just,
Yeah,
blindly just enter. Even though
and
even though this setup is actually like multi SMT, so in itself it's like a confirmation on its own, and then also there's this structure of these three institutional reference points. So it's not like you're trading blindly, but there should be some kind of PDA there, at least one time frame higher. So like if this was a 1 hour we were looking at here, I would at least expect you to say that there's a 4-hour something there that we are trying to trade from.
Okay, let me ask you the question in this scenario. So last week we found one even horizon, right? So that is already a kind of SMT, right?
Event horizon, yes, yeah, it's SMT.
Yeah, SMT. So now, so that say that is 4 hour or 1 hour time frame. Okay. Now when price comes to that point, that is an RSMT, right?
The second one over here would be number 2, returning to the previously created SMT. That is returning to the SMT. Returning to the SMT is closing the void, testing the order block, or trading into the rejection block, or taking even the high.
Right. But say, for example, I'm not sure which one happened there. I think in Dixie, it closed the SMT. I mean, we closed the void, but not on GU last week, right?
For what time frame is this now?
And I'm telling you the last setup that you missed because of one session, right? I think that's an even horizon setup.
Yeah, but if I remember correctly, that was based off of event horizon kind of setup, not this one.
Okay. I'm not sure.
Although, if we look at that 1 hour chart, I do remember seeing it that over here on last week, that this here was SMT somewhere here, if I remember correctly. So if I look here
Okay.
on the DXY at that same zone over there, I think this is where we see it here. You can see there that there's equal lows here and there's
Right.
a lower high there. So yes, that is SMT, and then as a result of SMT, price sells. So we get like an old high, we get a rejection block, we get an order block, and we get a void. Price then sells. We get event horizon immediately, right? So like as it happens, and then later on in the day, price returns back to that structure. You actually mentioned that, oh, this is actually another event horizon over here. But it was wrong because when price traded into this void over here, I said it's not event horizon because of the fact that that same corresponding void had already been mitigated over here. Remember that one there?
Yeah. Okay.
You see, so that one was a failed, well, not a failed because it actually, if we were trading that, you could see their price was over here. It didn't come back when this one did. So that's two. There was actually two then. I didn't actually see that one until later on in the day, but this is the one I saw in the morning over here. Then we got another one here. Then there was a sell. Okay. Obviously, it didn't take the lows here or anything, but it's fine. It's probably about at least 35 pips or so in here. And then price returned back up top here. So when it returned back up top here, SMT, RSMT, and then we could say that, well, if we see here, there is some kind of SMT, not on the actual highs itself, or you could say that's relative equal highs there, and that's a higher low. But in terms of the rejection block here, if you see their price traded into this rejection block, and it didn't over here. So there is some kind of SMT there. SMT is not always on the highs, guys, like we know. It's sometimes part of the open, high, low, and close, but that's obviously what we need to be attentive to.
So there are now two questions for me. One, first one is an SMT should have already occurred, and when price returns to that, the previously created SMT should have created some PDA array, like how it is created in GU. It has an old high and a void, and when price comes to that, it that's an RSMT, right? And after that, we have to find another SMT in our lower time frame to enter into the trade.
Yes, correct. That's 100%. So like, for example, here, okay, this is that structure only because there is an old high, a order block, and a void. Now remember, with an order block, although everyone just says it's the last up close candle before the down move, Okay, that's not the case. There must be some kind of expansion and inefficiency to show this that they sold into that up close candle. Without that void, you can't say that that's an order block. So, and to top it off, we already know that now because it's an order block, there should be an old high, there should be an order block, and now there should be a void. And then in addition to that same 3 institutional reference point structure, we attached SMT to that to confirm or confluence that trade idea.
Okay.
So it actually makes a really good setup a lot of the time. And it's not really limited to any specific time frame, this particular RSMT setup. It's really open to whatever kind of trading you want to do, because this happens fractally on the daily, on the 4 hour, the 15 minutes. It's really open to whatever you want to do on any time frame. This simple RSMT structure is one of the best setups I could, tell you to use. And it is the
Okay.
one I use and find the most regularly.
Okay. And now, sorry, the other question is in the same chart, right? When you are about to plot the SMT, how would you plot with? From the high of the red candle or to the high of the green candle, the pin bar candle?
This,
No, on GU. Yeah.
yeah, this year.
Uh, yeah. From that high to the high of the wick which was rejected, or the high of the red candle.
This one here.
Yes, basically.
Or this one.
No.
This one.
The first, yeah, I mean that's the SMT, RSMT, right?
Like this.
No. For RSMT.
Yes,
So
so this
now
this is the SMT, this is the old high,
SMT.
that's the order block, that's the void, and that price returns back. So the moment it's returning back into this void here, that is a return to SMT. So anywhere from this point, we are looking for a new SMT to be created. So above this line, basically at the closure of the SIBI, is fair game for a sell. And then once it's above here, you're going to be wanting, obviously you should mark this out like this, because the corresponding order block is like this, right? So this order block here is this order block here, and then just alone, just that is SMT by itself, right? Just that, right?
Yeah.
Okay, because
Yeah.
it didn't test this one, but it did test this one. So the moment it's
Yeah.
sitting above here, you're going to come there to your lower time frame looking for an entry. And then you're going to come there and say, oh, well, where is GU? Because it's not going to sit there very long, like you see here. It literally just tested this, and then it sold off over here. And then you're going to try and find yourself SMT over here. And sometimes, because it is so dynamic, that price may not, like you see here, it literally just taps that zone and rejects it. So you're going to have to either take the trade, miss the trade, or really be waiting for that area of price, or set an alert, or put a limit, or whatever the case may be. But yeah, these levels that we mark out are very sensitive because they're in the highest level of premium, so they don't sit there very long. So you can see there that price sat here for a couple of minutes, literally. So from 15 minutes, it was gone. It had left that level over here. I don't see anything too clear in terms of this 1 minute SMT or anything over here. So really it comes down, I do see one over here where it created this void away from that area and it retested it, but this one didn't over here, right there. So, if you're watching the 1 minute or the 5 minutes, you're going to have to put some risk on the table. The fact though that just by looking at the 1 hour, when GU was trading above here on the 5 minute and this one wasn't, that alone is SMT over there, and this one here. But it comes from experience. So the more you see something, the more you try and do it, the more you lose on it, the more you win it, the more you trade it, the better is you're going to be able to do and recognize the setup. You know, sometimes there isn't SMT, like there wasn't really too of a clear SMT, but you'll know to enter there just from experience.
Okay.
Okay, does anyone else have any questions about this RSMT? Okay, no questions. Manuel, I see you here. You're here?
Hi, hello.
Ah, yes.
How are you guys?
No, can't complain on you.
Hello, can you hear me?
Yes, I can hear you. I think everyone else is muted. Can you hear me?
Yes, I can hear you. I just joined the meeting, right? But your explanation is very good, so I have no questions so far. Just watching.
Okay, cool. I see there's only 7 minutes left of this recording, and it's not going to be enough time for me to explain this next one. So what I'm going to do is make a new one, and then you guys can just join back on that. So I'll quit this meeting, and then I'll send you this over here, like that. And then let's say there's, okay, it's a very easy way to see it, but you know, let's just say this is it over here like this. And then we know that that's an order block, that's a void over here. Okay, so let's say this is the DXY over here. So what we would want to see in GU down here is the opposite. So what would the opposite of this be?
We got an order blocking up candle.
Yeah.
Bearish order block.
Bearish order block.
Bearish. Isn't the DXY bearish?
No, it's a bullish. It's a bullish order block with up candle.
Okay, so it would be reversed to that, right? Okay, something like that. So what will happen is that we know that this is our interest point over there, and then we want to wait for one of them to close. Now we don't know which one. It can be either or, okay? One closes and one doesn't. That is what I refer to as event horizon. Okay, and when one closes and the other one doesn't, you're going to go into that zone on the tradable pair and look for SMT to be created, depending on if it's bullish or bearish. So that's up to you. If you want to use a trade idea like this, but this happens at least once or twice a week, and sure, you're going to lose trades on it. It's not always going to work out, but that's just the risk associated with trading. And yeah, that's just one of the setups. I think I use about 5 or so of them, but that's just one of them. And obviously it can happen on GU, so it can come down over here, close that void, and then maybe the DXY misses over here, and then you get an SMT like that, and it doesn't close that void. So while this one on GU closes the void, this one on the DXY doesn't. However, it can also be in reverse, where like this, the DXY comes in here, closes the void, and makes SMT here on a lower time frame, but GU sort of does this. The same thing. This one closed the void, DXY, and this one didn't. This actually happened last night before it sold. So I can show you one here. Let's do it on TradingView. So there was a buy over here. So if we zoom in here, you can actually see it. You could have bought this over here. This one here had a void, and it sold off here, right? You can see here that this one closed the SIBI over here, but did this one close down here? No. Do you see that? This guy here. Did it close this void? No. Did it create SMT here? Yes. So this one closed the void that it created. This one didn't. So then you'd come down to your whatever time frame you want, and you'd look for entry on 5 minutes, 15 minutes, whatever your poison, 30 seconds, 1 minute, whatever. But that happens pretty much every day if you wanted to. But at least once, twice, 3 times a week over here. So here's that order block. Here's that order block. You can see price comes in here to close that order block and that void, but this one doesn't. And then over here, while it's going higher, why is this one not going that much lower? It does go a little bit lower, but what does it effectively do? It just sort of bounces off here. Well, probably better to see it off of a 1 minute. Yesterday over here. And that is my event horizon setup. Normally it happens the best time when there's news. That's why it's nicknamed it like the event horizon, but it can happen pretty much any time there's a void created on the 1 hour. And this is a fractal, so like I'm doing it from a 1 hour, but you can do it from a 4 hour, you can do it from a daily, you can really do it from any time frame you want. There was SMT right there, over here. Once it had closed that void over there. So you want one of them when it's in the void to close it. Only once it's closed or in the void do you look for SMT. So all of this here before this price action is irrelevant. Only once it taps into the void on the 1 hour does it become, interested. So it's the same thing like if you look on the 1 hour chart right now, let's say there's a void here, right? Over there. And we mark that out like that. And it's very likely that, I don't know, maybe there is, maybe there isn't, but there could be a void here on the 1 hour chart for DXY. Let's just double check if there is, because there needs to be one. If there isn't, then it's not a valid setup. Let's have a look here. So it looks like there is, right? So over here, this is an interesting point because you can basically either set yourself a limit there as a reminder or set a price alert, whatever you want to do. But if this void was to be closed on the GU and this void to be closed on DXY, does it indicate symmetry? And if it doesn't, well, then it's SMT because the one closed void and the other one didn't, and then you're looking for lower time frame entry, 5 minute, 15, 1 minute, whatever your poison. So that's always something. So same here, there would be a void here even. This is a void there, and this is a void here. When price trades into that void, or this void, does the other trade into the same void? And if it doesn't, on the 1 minute chart, I would normally do it on the 1 minute chart. When it closes into this void over here, does this one close this void? And if it doesn't, like for example, there'd be a high here. There's liquidity there. So that could be a possible SMT, and then obviously this would be SMT also, same high, same low, like that. Is there SMT created there? Or it doesn't have to be that high, it could be new SMT created. How do I do that thing now? Where do you draw arrows? Anyone? There we go. So you want price to come up here like this and then do something like that. Or not that, but maybe price comes down here and then do something like this, you know, and then you take entry, and then your entry is hey, 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 like that. There's your SMT over there. That's your event horizon setup. Very simple. There's nothing complex about it. It's going to work sometimes, not going to work sometimes, you know, but if you don't put risk on the table, then you're not going to see the strategy play out. So even though you take 10 of these trades, you might only win, I don't know, 4 of them, 5 of them, 6 of them, I don't know. But if you don't take them, then obviously you won't know if it's working for you. And obviously when it does work, it's associated to how many R's you would get, always, as I see it. Because if it's not giving you the R ratio you want, then it's not something you should continue to do. For me, it works out pretty much. I'm not going to say all the time because that's a lie. It doesn't work out all the time because I lose some of these trades. But when I take them and I win them, I'm winning much more than I'm losing. So I'm losing 1R, but I'm making 3R, 5R, 10R, I don't know, whatever price action gives me. But it's a very good setup. But again, you'd have to go and test this out yourselves. I can't, you know, tell you you must do this only. This is just one of the ways I look for an entry sometimes. And it's also, it's got 2 elements here, obviously, or 3 if you want. It's got an order block most of the time. If it's not an order block, it's a SIBI. So there's one of your confirmations. Confluence would be SMT, right? So maybe there's an SMT there, but there could be double SMT. So like maybe this little structure appears above here, and then this would be SMT over here like this. So then what would that be? Another
Double SMT.
double SMT, exactly. So there might actually be multiple reasons why you'd want to enter this trade. So it's coming above this high, it's coming below that low, or it's not coming below that low. Either way, if it comes above there, we know it's grabbing liquidity. If it comes below here, we know it's grabbing liquidity, and we're still looking for, because of the distance, it's not closing the SIBI. This one is. So there's many ways to look at it, and the more you do it, the more you're going to get familiar with this price action. You know, I can't tell you what every single price action is going to be because you have to experience it for yourself, and the only way you're going to get experience is through exposing yourself to these entries. So that's just one of the few setups I have. So there might be a double SMT, you said, Samad, or it's based on event horizon. This DSMT thing is similar to RSMT. It's just double SMT or return to SMT. You might even find that maybe there's an SMT somewhere like here. Let's find one. Maybe there was one that occurred there. So here looks like sort of equal highs maybe, and then it's sold. So this would be maybe SMT here, and then price is returning to SMT, and then you're waiting for SMT again. But either way you will look at it, it's based off of a 1 hour void only. That's the way I want to do it. Okay, you can do a 4 hour void, you can do a daily void, whatever you want to do. I do it from a 1 hour, and then I'll wait if there's a reason to sell. And if there is, I take it. If there's not, well, then I don't take it. Like yesterday, there was one, but the problem with it was that there was this one. There was this void here that was both in the DXY over here and on GU. The only problem is that when it got there, the EG was selling hard, okay, which is obviously not a good thing. That was one indicator. And when it got there, it didn't even pause. It just traded straight through that zone over here. So you really, when it gets there, you want it to stop. You don't want to just see it continue. It must pause, at least on a 1 minute or a 30-second or a 5 minute for it to create structure, because we need that structure. I hate that word, but that's what effectively we need. We need the structure here to be created in order for us to take the trade. So we can't just, you know, take a trade that's going parabolic straight through here like this. Otherwise, it's invalid. It needs to get here and sort of pause in this zone here. Without that pause, then it's not really either a valid setup. So that is my event horizon setup. And also what can happen in this is the following, is that price can do multiple SMTs into this zone. Where did that thing go again? So it could do this. So it could go up, down, up, down, up, down, up, down, sell. Like that, right? So all of this could be SMT. So it could SMT into the entire zone and then sell off right from there. And that's just a characteristic of a market anyway, if you've ever watched it. So you can see it all the time, any chart, on a daily, for example. So, or even on the weekly, right? So there's a void there. Right, so sold, void, and then what does price do? It chops like this, up, down, up, down, up, and then it hits that zone, and then it drops. Sort of what's happening now, right? So that same thing, that's like an event horizon, if you will. Okay, you can do it from a weekly, daily, whatever you want to do, but I do it from a 1 hour chart. It's because 1 hour chart is sort of a mix between what's happening in the midday, each session, and day to day. So it's also going to give you at least once a day, maybe once every second day, a setup. So like maybe 2 to 5 setups, depending on how active you are on the charts, maybe one in the New York, one in the London. But for me, I only really trade London. So there's generally one every second day for me that would occur, and then I take the trade. But that's my event horizon, very simple, nothing complex about it. There's other trade setups I have that are a little bit more complex than this one, but this I'd say is the most simplistic one. But I mean, you know, you're going to have to go and test this out and try it for yourself, and then see you know, what works for you, journal it, all of those things. It's a whole process. You can't just, the strategy I use doesn't mean that now you go and use it and you're going to have the same results I do have, because, you know, everyone's different, everyone's mindset's different, thought process, psychology, all of that, emotion, all of that comes into play. So just because I do it and it works for me doesn't mean it can work for you. You have to go and test it yourself. Okay, I can do this again tomorrow night though. I'm doing a session tomorrow night because we always do it in the morning, and some of us live in the US. So to cater for those guys, I'm doing a session in the evening rather. But yeah, guys, I'm going to go have lunch now. Have a good rest of your day. It seems like this is just going to sell hard. Seems not stopping. So if you sold, good for you. If you didn't, maybe you'll get a retracement in the New York session. But yeah, I'm done for today. Maybe there's a retracement over there, which is also a 4-hour zone over here, maybe something like that. Okay, guys, well, have a good rest of your week. Yeah, obviously it also could come here and bounce like
that. Looks like we'll have a lot of manipulation. I remember you saying that November and December, there are a lot of manipulation. Maybe it's a good time for us to learn on this hard time about the manipulations.
Always. Okay, guys, I'm going to go now. So have a good day, good luck, good trading, and speak to you guys soon.
Thank you.
Thanks.
Nice day.
A new one, because there won't be enough time. So I'll label.
Okay, so let's see here. Okay, anyone hear me? Screen recorder. Yes, I'm recording. Okay, there we go. So, like I say, it's structured SMT. Okay, we all know what SMT is, how it looks, where to find it, what to do with it, and it's 2 o'clock now, so that means the central bank's dealers range has ended. Okay, so we're not caring about that. It's structure based. Okay, so what you see is I've posted in the group here these lessons that you can go watch. So obviously, if you don't know what a breaker is, okay, or you want to refresh, go watch the video. ICT has done us a service by posting it all on YouTube. And then here's my notes of the breaker, or how to find the breaker. Okay, so that is going to be a breaker. Okay, so you can go watch that, look at the notes. Then there's also going to be a mitigation, and we're going to look at the mitigation. Okay, so you must obviously understand what a breaker is, how to see it, and you must understand what a mitigation is and how to see it. Otherwise, this, what I'm going to explain, is not going to really help you in any way unless you understand those two core mechanics or concepts. Okay, so let's just have a quick recap ourselves here. Very easy. Okay, if we look at a breaker, we are going to say that the very similar to mitigation, the difference with a breaker is how the structure would be the turtle soup. Okay, and that breaks the swing high or low that generated the turtle soup. Okay, so obviously with a breaker, it's very important that there is some kind of liquidity that needs to be taken. Okay, that's the main difference with a breaker. Okay, so obviously if we look at how that would look, we've got sort of maybe some liquidity over here that's either consolidating or whatever the case is. Okay, so there'd be liquidity over here like this, and over here we'd have a move higher and a move lower. So we are looking for the swing low of that move, okay, which would be possibly over here, and then this would be your breaker over here. Okay, it really depends on what time frame you look at it, because if you look at it from a lower time frame, the breaker might be here. Okay, but it really depends on what time frame you're looking at. So if you're looking at it from a lower time frame, the breaker is going to be at number 1 over here. But if you look at it, say from a 4-hour or another time frame, the breaker might be over here at number 2. The important part about the takeaway from a breaker is that it is the swing low over here, depending on which time frame you use, that grab the liquidity up top here. Okay, so that is our breaker. So we would anticipate that if our breaker is at one of these levels of number 2 or number 1 over here, that when price stops going lower over here and heads back higher, that this would be just a short return to breaker over here. This is a return to breaker, okay, RTB, if you will. Okay, so that is a return to breaker. So our understanding of the breaker is that there must be a liquidity grab, and then the structure of the market has broken. Okay, and that is our breaker. So I'm not going to go too much detail into the breaker, and then obviously it's just reversed if price is doing something like that as well, and there's liquidity over here, and then it breaks the liquidity, and then boom, price rallies, you know, something like that in reverse, right? Here's your liquidity, and depending on what time frame it's going to be at this level or this level. Okay, same thing, but just reversed. Number 2 or number 1, or rather number 1 or number 2. Okay, that's basically your breaker. Does anyone have any questions quickly about what I've just said?
Not from my side, thanks, sir.
Anyone else? No questions? Quickly? Yes, no?
No.
Okay, so if we understand what the breaker is, let's quickly look at the mitigation. The mitigation is a move high over here and then a move low. So we've made a high, so there's liquidity above this high, and price makes a swing low at the bottom over here, and price moves away from that swing high to that swing low, and it generates liquidity both on the upside and the downside. And the fact that price makes a failure swing by trading here, this is what we refer to as the mitigation block. Okay, so really your mitigation is over here in this area here, So that if price returns back there, that is your mitigation over there. Okay, and then obviously in reverse, over here we make a low like this, price trades higher and makes a failure swing. So your liquidity over here and over here, same thing there and there. Price fails to take out the low and trades higher, and over here is our mitigation over there. So that if price comes back, we are looking to potentially take a trade at the retest of this mitigation for high prices or lower prices if we were selling. Okay, so that is breaker and mitigation. Okay, you guys can go and look at the nitty gritties and watch the ICT videos of that. I'm not going to spend a lot of time on this. Okay, what I'm going to spend time on is the SMT surrounding the nature of this price action. Okay, so that's where I'm going to spend time because this is the relevant stuff. So, number 1, number 2, and number 3. Okay, now you're probably going to say 1, 2, and 3, old high, order block, and void. Okay, 3 institutional reference points. But I'm not talking about that. I'm going to say this is liquidity.
Hold the high.
Okay, so this is liquidity. Number 2 is what?
Orderblocks and
Structure.
Hold high.
Right?
institutional order flow.
That's it. Then number 3 is what?
Sorry, I missed it. What was the question? Okay.
Structure.
Structure. Okay, so liquidity, order flow, structure.
Structure.
Okay, so now if we understand, obviously number 1 and 3 can still be order block, old high, void, etc., but for the purpose of what I'm explaining here, this is what we are thinking about. Liquidity first, then the order flow because of the liquidity, and then as a byproduct of liquidity and order flow, structure is created, right?
Yeah.
Does
Yes.
everyone agree? Does anyone disagree?
Agree.
Okay, so if we understand this, okay, and we understand mitigation and we understand breaker, then applying SMT to this nature of this price action is actually pretty easy, okay, because all we are going to need is the following. So we're going to get a high, and then it's going to make a failure swing like this, and boom, there we go. What is that?
Failure.
Okay, so this is a mitigation, right?
Yeah.
So the principle behind this entry, okay, this entry technique surrounding SMT, okay, is guided by the structure element of things. So if we know up top over here is the liquidity and the order flow over here has potentially changed on like a 5-minute, a 15-minute, a 1 hour, a 4 hour, whatever time frame you're looking at, okay, because this mitigation we're looking at here can be fractal of any time frame, right? Okay, so we are saying that here has created a mitigation by trading through that failure swing high, and this swing low has now been traded through here. So does anyone have a clue of how we would anticipate or use SMT with this price?
OHLC SMT of that mitigation block?
Yes, there could be SMT, true. There could be very well SMT from this swing high to this swing high, right?
No. What I'm saying is there is a mitigation block formed, right?
Yes.
So to enter trade on this, right, we can see OHLC mitigation on that mitigation block.
Yes, that's true. We can, okay, because we already now have this mitigation that has taken place over here. So whether or not SMT occurred from this two swing points is irrelevant, okay? Just by looking at EU or GU or whatever you're doing SMT with, we can see that this mitigation has been created. So what we can then do is saying, okay, this mitigation has been created, and from having created this mitigation, then we can pay attention to the price action that unfolds after the mitigation has occurred. Okay, and this is the nice thing, guys, is that I've shown you a entry technique using that event horizon, and now I'm giving you this as well. But obviously, if the more you understand, the more you can use in all of your trade examples, okay, or trade setups or whatever you want to do. The more you know, the better. Okay, it's just how you use the information. So once the mitigation has occurred, then we can go and look for SMT. And how we will do that is by doing the following. So obviously, if this is EU or GU over here, we would anticipate bearish price action, right, for selling, correct? Yes, no?
Yeah.
Okay, so then the same move, okay, if it is symmetrical, okay, which is fine for price to be symmetrical. We had the same occur in the DXY, right?
Okay. Yeah.
So it is symmetrical because both of them have created some kind of mitigation.
Correct.
Okay, there doesn't have to be SMT over here and over here for this to work. We just have to get a mitigation, and we have one. So now our structure element has changed. Okay, so going back to this over here, liquidity, where's the liquidity? Well, it's below this low. Where's the order flow? Probably over here, between this move over here to here. Order block, void, etc., right? So that's where your IOF comes in, over here. Where is the structure? The structure, so let's label this. This is number 1 over here where the liquidity is, number 2, and in between here and here is 0.3. So we are trading number 3 now. We're trading structure. Okay, so if the structure has been created, there shouldn't be a need for price to come back to number 1, which is liquidity, because of the structure, right? Now, I'm not a fan of mitigation or breakers, but they, they do work, okay? So we can't deny that. And by doing this, we are now looking for a sell on the foreign asset, be it EU or GU, right? Or AU or whatever you're trading, okay? For myself, it's going to be one of these two, okay? Up top here. So we're looking for a bearish move. So how we can do this is by watching now. We're anticipating a bearish move, which would be bullish on the DXY, right? Because now we've both got a breaker or a mitigation on this zone, so that when price comes back into this zone, like we expect, we are now waiting for SMT to occur anywhere, right?
Yeah.
So that SMT could be something like this, where price comes in here and this one goes over here.
Right. Yeah.
So here we have SMT, and here we have SMT.
Non-symmetrical.
Or we have something like this. Right, so there could be SMT there too. Or here. It's going to be easier when I show it to you on the charts, but this is the nature of this whole structured SMT basically. You're wanting a breaker or you're wanting a mitigation to occur, either to buy or to sell. Obviously, this I'm showing you a sell here, but it's just reversed for a buy. It's the same thing. The structure has told you it would like to sell in this case, and then you are looking for a reason to get in the trade. Where can you get in? The confirmation is what?
Order blocks.
Mitigation.
Void.
Well, in this
Yes,
case, the confirmation is the breaker, right? Or the mitigation.
Yeah,
Mitigation. block.
mitigation.
Okay, so then the confluence would be the SMT part of things. So, if we understand this, does
The
anyone
same thing
not?
happening in GU now.
Sorry?
No, the same thing is happening in GU now.
The same thing is happening in GU now. Okay, let's have a look here.
Now, yeah.
Okay, well, the same thing did happen in GU, which is, just coincidence that I was going to show you this anyway. Okay. Quickly, how do I remove all of these markings on my chart here without deleting them? Anyone? Is it this thing?
Delete button. Yeah. Yeah.
Okay. So let's look at this, right? What do we see here? Come, guys, what do we
Failure
see?
swing. Failure swing.
Okay, we've actually got two. We took this high from this swing low by moving higher here, and then the market broke, right?
Yeah. Yeah.
So
Yeah.
this would be what?
Breaker.
Ah, greatness.
It will come. It will come.
Okay, well anyway, that's the breaker, right? Over here. It's not all the time that price creates a breaker and a mitigation. I'm not showing that. I'm showing one or the other, or sometimes both. Okay, but generally, what comes first, breaker or mitigation?
I mean, it's breaker first and then mitigation.
Yes, sometimes one, sometimes the other. We don't know which one, sometimes both.
Yeah.
In this case, it's both, but most of the time it's breaker first and then mitigation, or mitigation only, or breaker only. Okay, so what I'm showing here is the fact that the market broke, okay, by trading lower here. So there's our first break of structure here. We are then saying that because the breaker was created here, that somewhere here, over here, is going to be a SMT, right? Right?
Yes, yes, yes.
So where is the SMT?
There is, yeah. GU is higher low.
Exactly.
Sorry,
low.
low or high.
Yeah, low or high. Okay, so there was that one.
Yeah.
Okay, there was that one. Now that's off of a breaker. Okay.
Okay.
We are lucky though, because not only was there a breaker, there was also mitigation. there was mitigation here, right? Because this swing low failed to take out this swing high, right? Yes?
Yes, correct, yeah.
So you could have either taken the trade over here or over here, ones that had traded through here and started to retrace. You are looking for SMT at the mitigation or at the breaker. Does this make sense, guys?
In 1 hour, 1 minute also, it's showing the same story now.
Okay, so this is a 1 hour breaker or 1 hour mitigation. So that means if you are doing it from a 1 hour, you're going to go down to a lower time frame and look for SMT because the breaker is on a 1 hour. But the same rule would apply if it was a 4 hour. If this is a 4 hour breaker or if this was a 4 hour chart, the same rule would apply. You'd use a lower time frame for SMT because you believe that the confirmation of a breaker or a mitigation has the reason to sell, and then you're looking for SMT once that has changed. Does everyone understand?
Yep.
Yeah.
So not only was there this over here where, remember this morning I said there was this void fill over here on the DXY, okay? That's one maybe, okay? But if you didn't know what this was, the other way you would trade it is that, well, if you look at this mitigation over here and here, okay, you are anticipating price to be bearish so that when it returns back inside here on the lower time frame, you are looking for SMT. Because the mitigation is telling you it's selling, or the breaker is telling you it's selling. But let's forget the breaker because we missed that. That was before the London session. But after the London session or during the London session, we had the mitigation to trade off over here. Okay, now I don't trade Asia session, so I missed the breaker over here. So then I've looked at the mitigation. And then because we're doing it from a 1 hour, you're going to look on whatever time frame you prefer to look at, if it's 5 minute, 15 minute, 1 minute, or whatever the case is, and you are going to look for SMT. Because why? We know to sell because of the breaker. It's the same as the order block, right? When price trades into a 4 hour order block or a daily order block, we are anticipating a move against that, right? Right? It's the same concept here. The
Correct.
mitigation shows you that it has created a bearish or bullish mitigation or bearish or bullish breaker. Then as a byproduct of that, it no longer seeks the liquidity to that high or that low, and the structure told you it should sell, in this case sell, so that when price comes higher, it's likely to create SMT. How do you find SMT? Well, SMT on swing highs, SMTs on open, high, low, and close, SMT on mitigation, SMT on breaker. Do we see here that this blue line here represents mitigation on the 1 hour chart? Right? And this blue line over here represents mitigation on GU. So when price created mitigation by trading through here, we would anticipate that, well, if the DXY is trading into the mitigation, a symmetrical move on the pound should be also a trade into mitigation. Right?
Correct.
Correct. Exactly.
Correct.
And then if you have confirmation like this, although this is not SMT here, right? That's not SMT, right?
Yeah, symmetrical.
There is still SMT though. So this is still just a turtle soup above an old high where you can enter a position.
Correct.
So Mud, often you ask me, where's the 1 minute confirmation? Well, the 1 minute confirmation is a move above an old high here that is still symmetrical on this 1 minute time frame, but not symmetrical on a 1 hour. So that is just a turtle soup sell model. Make sense?
Mm,
Yeah.
no, sorry, I'm not getting it. This is how you say this is an asymmetrical move. This turtle soup of this high.
This is a symmetrical move on the 1 minute, right? We can see here that there's a swing low here and there's a swing
Okay,
high here. And on the 1 minute chart,
correct.
both the pound and the dollar index grab the
It's
liquidity,
broken.
right?
Yeah.
Yeah. Same GU. Same here.
But it's symmetrical on the 1 hour, sorry, on the 1 minute, but on the 1 hour where we found the mitigation, telling us it's a structure break, this is a turtle soup above an old high because the 1 hour is bearish.
Right. Okay. So it is symmetrical move on this time frame, but the mitigation. Okay, while doing that symmetrical move on Dixie, it has closed that symmetrical. Sorry, that mitigation block, whereas in GU it is not there. Is that what you are saying?
Yes.
Okay.
So you may have
Correct.
been looking on a lower time frame like a 1 minute for a non-symmetrical move, but you never got it because this was a symmetrical move here.
Mm-hmm.
But the
Yeah,
1
but on
hour
the 1
is
hour
still bearish and it's still SMT on the 1 hour, or if it was a 4 hour, for example.
mitigation SMT.
And you can also see, in addition to that, obviously we know that this purple line here was a 1 hour void on the dollar index, and there was a 1 hour void over here. But besides that, even if that void wasn't there, the mitigation is still there. The one mitigated, the one did not. That is non-symmetrical.
Yeah. Yeah. DXY
So
is
that any
doing.
lower time frame price action, depending on what array you like to trade from, I personally like to trade old highs. You turtle soup an old high, regardless of if it's symmetrical on the 1 minute or not. The higher time frame is, bullish or bearish in this case.
But D in real time world, right? We always look for at 1 minute. I mean, the same trade. If you change that time frame to 1 minute, and where you would have entered and where you would have kept your stop loss.
Well, entering would have been above this high over here.
That's what. So the high at 1 minute time frame, if say if that candles are not printed after that red, right? Only that green candle is found and the red is not printed at. How you would have entered the trade?
Well, you either execute, you put a limit, or you wait. So if you didn't sell the old high, then you would have had to wait for the order block, the void, or it returning back to close the void. So here you can actually see it closes this void here on GU,
Okay.
but over here it doesn't.
It's not there. Yes.
And in addition to this, I have a yellow line on here, which is the opening price of the candle that is bearish candle on GU and a bullish candle on the DXY. So if price is below an open or above an open, that is a sign of bearishness or bullishness, depending on if you're trying to buy or sell. In this case, we're trying to sell, so we are trying to sell above an open. Okay, so I'm going to obviously leave it there for now. You guys can absorb this, go watch the other additional videos, and then I will take questions from all of you regarding this.
Cool.
But for now, just absorb
Thanks.
it.
Cool,
Okay.
Darren. Thanks, man. Awesome.
Okay.
Cheers, guys.
Thank
Have
you.
a nice one. Much appreciated.
This Okay, so we should do this one. I'm not going to give it away, but this is just standard SMT, right, guys? Is that correct? SMT from this foreign asset
Yeah,
to this
yeah, correct.
Dixie. This is the Dixie at the bottom over here. And then this is the foreign. Foreign EU, GU, AU, whatever you foreign. Okay, so this is just standard SMT. So obviously we know that that's a setup that could be, you know, fractal of an H1, H4, pretty much any time frame, right? There's no sort of rule as to what that structure is. That's a standard SMT. Okay, so this is an SMT based off of, let's say, something on a higher time frame. Because when we say higher time frame, we don't necessarily always mean the monthly chart or the weekly chart. We just mean that higher time frame, higher than the time frame we're going to enter from, right? So if we take entries, say on a 5 minute or a 1 minute or a 15 minute, we know the higher time frame is representative to 1 hour, a 4 hour, 8 hour, if you will, daily, anything higher than the time frame we're looking at right now, right? So that on its own is SMT, right? But if we look inside that structure over here, and we know this structure here on this, let's say this is a, I don't know, H4, right? 4 hour chart, okay, on both. We know that the move below this liquidity point over here and the failure to move above this liquidity point over here, because we know that that's now it's a failure. Okay, I'm not showing mitigation block. Okay, I'm showing that there's SMT here before the mitigation block has been created, because remember price has retraced here, and before it takes the high, we see the DXY take the low, right? So we know that it's SMT over here. So we want to try be buyers below or sellers below that high or before the mitigation block has been created. So we know that the 4 hour has created SMT, and when we go to a lower time frame of say a 1 hour, 30 minutes, 15 minute, 5 minute, and we look at that structure, it's going to be vastly different, right? So this large price swing to the upside could look something like this, right? On a lower time frame. It's not just going to be one like it is on that higher time frame. On the lower time frame, it's going to look something like that. Okay, now if I just zoom out a bit here and drag this across, okay, and price then goes lower like this, sort of similar to how the higher time frame on the 4 hour would look, but the only difference is that because it's a lower time frame, there's going to be more price action, there's going to be more candles, and obviously as a result of that, because it's a lower time frame and it's a fractal of the higher time frame, there's going to be more what in the chart? What's there going to be more of on the lower time frame than there is on the 4 hour time frame? If this was a 15-minute chart, what is there going to be more of on this 15-minute chart as opposed to this 4 hour chart? What is there going to be more of, guys?
Structure.
I hate that word, Roger. But yes, if you will.
I know you hate it.
Structure what? PDAs, right? There's going to be more voids, going to be order blocks, there's going to be equal highs maybe. You know, there's going to be a lot more PDAs on this lower time frame, okay? But as price is obviously this same swing high over here is the same swing high as this one over here, but just on a different fractal on this 15-minute chart, right? So we know that once price starts to move higher over here, the DXY has done this, right? So it's traded lower and then it's traded higher, something like this. And then now it's sort of trading lower over there. Sort of the exact same structure, except this one, like we see on the higher time frame, has already taken this liquidity over here. So it's already trading inside of this what? Sell side liquidity, right? Okay, so we know that when the DXY over here is trading below this low and the failure of the foreign asset to trade above that high, both on the 4-hour and on this 15-minute, because they're going to be the same, right? It's the same thing, it's just fractals. We are wanting to do what with this? What are we trying to do here? Where am I going with this, guys? Does anyone know? Well, if it's a turtle soup, Siva, then it's not going to be a symmetrical move, right? Not so? Because then both foreign asset.
No. No, what I'm saying is um, the upward move that is happening, right? That we can again look for some turtle soup within the high of the high that is marked X. Yeah, within that high.
So anywhere you mean below here?
Yeah.
Aha, there we go. That's correct, guys. So you are correct. So you should have just said that, Thiva. But anyway, you are right. So what we are essentially looking for is here that we know the 4-hour on the Dixie has traded lower than the low, but the foreign asset has failed to trade higher than that high on both the 4-hour and on this lower time frame 15-minute chart. So does anyone have any idea what we can do with this information? I know you said turtle soup on a lower time frame, maybe, Thiva, but what else could we look for here?
Again, the same things that we look on higher time frame, like the void fill or some mitigation loss.
Okay, perfect. So you're right. Okay. And we can definitely say that within the 4-hour structure that was created on the foreign asset, that's somewhere between the old high and this recent old low over here, because this would be the old low that's recently created, that would be the old high. Somewhere inside between this old high structure and old low structure, there's going to be some kind of maybe old high, order block, void, maybe even. We don't know what's there. Okay, so besides the confirmation aspect of things, the fact that the liquidity on the foreign had not been taken, but it was taken on the DXY, suggests that there could be a turtle soup here already taking place, because we already know that this is SMT over there on the higher time frame, but not trading higher here. Okay, so that is a higher time frame. And then what we essentially are doing is we are looking for another SMT over here somewhere. Somewhere here, there's going to be an equal high or a lower high, maybe somewhere like this, equal highs. It's creating higher highs, equal high, maybe a lower high, something like that. I don't know which one is going to occur, but one of them will give us potentially an idea of when it could occur, and we can use this 15-minute over here to enter off here. Okay, so we've got a higher time frame SMT and we've got a lower time frame SMT. We've got two SMTs. So what is this? It's SMT, but what SMT? I've taught you guys this before. You should know it. What's going to be the prefix of this?
Double SMT.
Yes, thank you, whoever said that. So it's going to be a double SMT over here. It's a very simple setup. Okay, obviously it's still all the time, every time you're looking for SMT. SMT is the confluence. It is not the only reason why you're taking a trade. You're taking a trade based off of PDA. Old high, rejection block, order block, void, mitigation, breaker, equal highs, whatever you're going to find, that's going to be your PDA. Then, because of the higher time frame 4-hour that failed to take the high on the foreign asset, we are looking for price to head lower because DXY was able to take the liquidity below the low over here. And we are looking for an SMT entry with that being the confluence, and then maybe somewhere inside of here, void, order block as a confirmation, maybe somewhere over here, maybe a turtle soup above this high over here. We don't know. Okay. Every chart is different, but the price action repeats itself. We just don't know in what order it's going to repeat itself. So if we take a setup like this and we take 5 of them or 10 of them, we might lose 2 or 3 of these trades, but 1 or 2 of them is going to work. And that's the same situation with everything, unfortunately, in the market. No setup I'm going to show you ever is going to be a winning strategy all of the time. Unfortunately, that is where the risk and reward comes in and helps us substantially more than the others. So possibly the other situation would have been the ICT traders waiting for this mitigation to occur down here and then only taking the trade when it comes back to either test the mitigation or to test, because then they're waiting for that structure break. But because we can take a more of an aggressive approach to this, if you would like to call it aggressive, we could be entering in before that liquidity, which increases our risk reward substantially. So if you've ever seen a trade set up like this, it substantially increases your risk reward. And also the setups that don't occur all the time, not every day, but if you are active on the charts, you will see them occurring 2-3 times a week. Okay, so this is double SMT, and again, this double SMT is not specific to what I said about the 4 hour going down to the 15-minute. It could be a 1 hour down to a 5-minute, could be a daily down to a 1 hour. It's really respective to what time frame you are looking for. Okay, and obviously, as with anything, if you are selling, you're selling in a premium. If you are buying, you are doing it in a discount, obviously. That's still a rule that would apply to anything and everything I would ever teach you. Okay, you can't just sell wherever. Must be a premium. But obviously knowing that if it came from that high and it came down to this low and it started moving higher here within this new range it created and moved above an equilibrium of 50%, cool, it's in premium. There you go, no problem. Right, so just be patient. If you see it already making SMT while it's moving up and the DXY moving up, wait for a 50% retracement, because then it's into the premium of this range at least. Doesn't have to be in a premium of like a IPTA data range of 60 days or 20 days. Can be just, a premium of a range, specific to whatever we are doing, because all of what we are doing would be internal range. And where would the external range be? At this swing low. So if we were entering, we would look to take some profits when price trades into this low over here. Boom, we take profit. And obviously, because we are in the trade much earlier, it's very likely that price would trade through here, maybe retest only a portion of this, and we've already scaled out here, so we can actually still leave some profits on and possibly maybe get another re-entry over here for our trade again, to just target one more low of that swing low that was created over there. And that's sort of double SMT. You're using a confirmation of a PDA and 2 SMTs in one. Okay, that's obviously DSMT, but there's another DSMT over here. So the same structure, I'm going to draw it out here again over here. So similar situation over here, we've got a high, then it's created SMT over here. Okay, well, let's just say that it didn't take that low yet, like that, and then something similar over here, where it took the low over here, it failed, so SMT. Okay, so there's SMT there, and what could happen is another SMT would occur down here, like this, or like this. That's double SMT. Okay, and what else could happen is the following. So there obviously there'd be SMT by trading below the larger swing low of this liquidity point over here, over there in the Dixie, and not taking the liquidity of that high. There's SMT. So again, we've got double SMT over here. And if we go to a lower time frame, we might see an SMT for a higher high and a lower high. something like that, it sells off, and then failure over there on a lower time frame inside of this area over here on, say, 5 minute, 1 minute, 15 minute. There might be double SMT over there, and really it's the same thing, but you know, you got your double SMT over here, but in addition to that, you've got like a third SMT, which is just TSMT. Okay, it's really the same thing. It just means that there's a third one in the mix over there. So sometimes there's two, sometimes there's three. You know, I've seen 5 or 6 sometimes when the market's really accumulating or distributing price action on a lower time frame. And it's not unlikely that it could, you know, turtle soup each high or failure swing each high, but you really just got to watch out for that price action. It occurs regularly. And again, with this setup, just like RSMT, if you know these patterns I'm teaching you, you're going to get, if you know, say, 4 of them off by heart, you're going to see them, at least each of them, at least once a week, one of them. So if you know 4 of them, you're going to have 4 trades a week on each of these patterns. And obviously, you're not going to win all 4 trades, but one of those trades is going to pay you substantially. Okay, and I don't make up risk rewards. You guys know that I sometimes get big risk rewards, you know, 10, 15, 20 Rs. Okay, and not every trade's like that, unfortunately, but you really just need 1 or 2 really good trades a week and you're sort of done. You know, there's been weeks where I've traded on a Wednesday and made my weekly goal. I'm done. You know, I don't need to continue. Obviously, because I'm FTMO, I have to, but that's just how it is, right? So that would be DSMT and TSMT. And then before this lesson now, I taught you or recapped what RSMT is. Okay, so does anyone have any questions regarding what I've just told you about this?
D, I have a question.
Yes, sure, go ahead.
The first question is, what is the difference between SMT, RSMT, SMT, and the double SMT?
What is the difference?
Yeah.
Well, the difference is that with RSMT, double SMT can occur within there. That's why what I'm showing you has some relationship to the other things. Like if you know event horizon, right? It's very likely that event horizon could occur at RSMT, right? I'm sure you've maybe seen that, if now you sort of know that structure. Or RSMT occurs and there's actually double SMT at the RSMT. So instead of, we've got SMT like the structure I just showed us, right? Let's see if I've got it over here, right? So we've got this structure here of the SMT, the RSMT, right? So when price returns back over here into this RSMT, right? This could be double SMT there. This could be some kind of event horizon going on a 4 hour maybe, on a 1 hour maybe. I would only look on a 1 hour, but all of what I'm showing you is somehow interlinked or interchangeable with one another. So you can see there's slight variations of what I'm showing you, but they are different in some sense that if you know what you're looking for, you're going to find quite a lot of setups. The difference is that when you know like SMT, when you know order block, void, your PDAs, you know order flow, you know all these things, right? But if you don't know how to formulate them into some kind of plan or pattern recognition, you're just going to sit on the charts all day long, right? Because then you're just browsing price, right? But this is actionable, right? So if you learn these things, you can make action on them, not just stare at the charts and say, oh, but this could have happened, that could have happened, I should have taken this, I could have taken that. You could sit doing that all day, but I'm teaching you to be actionable on the charts by learning this with, you know, looking at it from a perspective of whatever you're trading. You know, I trade GU, right? That's my pair. And most of the time when I'm trading GU, I'm selling it. That's just how I do it, right? So if on hectic buy days come, like last week was a hectic buy week, right? I had limited trades, right? I had to wait, I think, till Wednesday or Thursday when it sort of made that one little trade, and that's all I took, because my strategy tells me I sell GU and I only trade GU, right? And I use SMT to get in my trades. But if that condition is not there, then I have no trade. So you, as the newcomer to trading, need to create these conditions or these systems for yourself. Now, I'm not telling you that you must only trade GU when you trade GU, you must only sell it. Okay, I'm teaching you anything you want to do, but with this price action, right? This price action is fractal, meaning it's adaptable to anything.
Okay.
It's all very well, guys. We know ICT, we know all the concepts. It's like him posting all of that stuff on YouTube. And we were discussing this the other night, is that it's all very well, it's on YouTube, but you know, you could sit for hours. But if you can't turn what you're watching into something that you can actually do and make it actionable, it's irrelevant, because there'll people be watching it there and they're probably bored by his voice. And then they just sit there, watch it like a Netflix series and binge watch it, lesson after lesson after lesson, and not know what the hell's going on and how to piece those puzzles together to create something. That's why many people who watch ICT don't believe it or have no relevance of or how to perceive that price action. So I'm not teaching you guys anything new. This is all ICT. I didn't make this stuff up. I take no credit for this. It's just my interpretation of what I've learned. That's the difference.
Okay.
Okay. Anyone else got any questions about whatever, RSMT, the double SMT, the third SMT, anything like that? Anyone got any questions?
Hi, Darren.
Yeah, Manuel, go ahead.
Can we go to a chart on GU? That's
On-
about Friday.
On the DXY as well, or just GU?
We can do both. We can do both.
What time frame would you like to look at?
1 hour. There was this daily BC that we were waiting to
Over here,
to
yes,
close.
I remember that. Yeah, somewhere down here.
Yeah. When DXY closed, then GU didn't.
Yes, that would be.
Yeah, just not.
That's actually a good representation of what event horizon could look like, but from a daily perspective, right? So think of that daily BISI, right, as if it was a 1 hour BISI. Now, when that 1 hour BISI filled, but then GU didn't, that's event horizon, right? So I told you guys this can happen on other time frames too. It's just the only difference is that the higher you go, the more variation there could be in the size of the stop loss, because obviously it's a higher time frame. So when this SIBI here filled on the DXY, you can see I've already had this marked out over here. This one here didn't, like you say, Emmanuel. So this here too is SMT by itself. So the fact that it closed and it didn't close on here, this is that daily BISI, this imbalance over here that did not fill but was filled on the DXY. Again, that is SMT by itself. So what you do with that information is entirely up to you, but it is tradable. It is tradable in the way that because it did not, you would want to see price accumulate over here on a lower time frame. What is the confirmation? Well, the confirmation is the fact that price is already inside of an imbalance. So it's already a potential buy just by doing that. That's the confirmation by itself. Then what's the confluence? Well, the confluence again is the fact that the daily SIBI was closed, but on GU it was not. So that's a confluence by itself. Then on a lower time frame, when it came in there, okay, you weren't trying to catch the low maybe over here, but from this point over here, you can watch the lower time frame and look at the price action, watch the price action, and try to trade this lower time frame price action based on the fact that it's not closing the SIBI, but it did over here. Why is it going much lower or not going much lower, but this one is going much higher? Once, where's the same void of expansion lower as the expansion higher through the void over here? We can see that it's being accumulated. You can see that there's a void here, but it's not, it's basically one candle, and then there's a second expansion over here. It goes higher, sure, it goes lower, sure, but it's not the same. You can see it's accumulating. So from this point over here, you're going to be looking for some kind of entry over here. And if you're going to enter something like this, well, then you're going to use maybe, I don't know, 10, 15 pips stop loss. 10, 15 pip stop loss is not big. I mean, geez, you guys can trade with a 20 pip stop loss and still make good money. 20 pips, this move here was like 90 pips, I think, if I remember correctly, all the way from here. By not closing this void until price closed, price moved more than 100 pips here. So it's not like you had to try and catch the low. Remember, SMT, yeah, sure, sometimes you'll catch the ultimate low or ultimate high inside the sell side or buy side liquidity, but it's not always about that. It's about trading what you see. So like, for example, the fact over here, you could have said that, okay, well, the DXY closed this BISI or the SIBI, but GU didn't. And when it didn't, okay, I'm watching this, I'm waiting for something. Well, what is here? So it traded through here and expanded higher. What is this? Well, that to me looks like an order block on a 1 hour time frame right there over here. So when price retests that, you can get in on that. Or if you're looking at a 15-minute, well, it's the same thing really. Before the 1 hour is created, price is starting to move away from that zone over here. You're not trying to trade a breakout, you will just wait for a retracement over here. Does that help you in any way, Emmanuel?
Yeah, it does. But what actually happened on Friday? When DXY closed the BIS and GU didn't. I was looking at 1 minute chart. Can you go to 1 minute, please? Right in the moment where one did close and one didn't.
Over here, because the void is just below here.
Yeah, over there. So what actually happened? I end up leaving. I end up leaving the trade because on this low that was created right next to the close. So I was looking on to happen some total soups because of this equal lows over here,
Yeah.
and those two equal lows over there. Yeah, I was expecting price to come and rate those lows and move higher, but it didn't.
I see.
The reason why I couldn't take the trade because of that.
I see. Okay, well, I can tell you now that this is highly likely that from this zone over here, that there would have likely have been some kind of RSMT over here. So somewhere here, there would have been some kind of SMT. Price would have expanded higher and then returned back to some of the previous SMT it had created. And somewhere along here, I'm certain that there could be another SMT. So this would have been SMT over here, like that. And then price would have returned back to the SMT by moving lower here. And then again, price would have made a new SMT over here. So SMT, RSMT, SMT. Now, I don't know that because I didn't look at the price action, but I'm pretty certain based on what that looks like, there's going to be something like that. Let's see. Okay, so there's that same price action, right? And if we zoom in here from that zone, and we look at this more refined over here, there's the non-closure of that BISI that we saw on the daily, and over here we can see price traded higher over here, and over here I said that it's very likely there's going to be an SMT, and I can see an SMT right there. So over here, this is a failure, and this is not a failure. It actually traded lower there slightly. And then if that's not your entry, it's fine. You missed it. So what? Great. Price expands. Okay. Well, you don't trade the breakouts. You wait for the retracement. Okay. Where's the retracement? Well, there's one right there. Over here to here. SMT. SMT. Boom. Equal lows. SMT again. Right there. Higher high to here to here. Look how many times you could have entered there with a stop just below here, Emmanuel. So like if you looked at GU, I said I didn't look at the chart. I didn't know because I didn't look at the price action. But based on this nature of this price action, if it's accumulating like this, with the closure and the non-closure, we could have taken a trade somewhere inside here with our stop. I don't know, let's say at the top of this box with a stop just below that low, 14 pips, 15 if you will. Okay, so it's really not that much. If you get a 1 to 3, you just need 45 pips. 45 divided by 15 is 3. So, you know, price moved more than that. It moved 100 pips, okay? So what? You didn't need it all. Okay, so 15, let's say you took a 5. 75 pips of the 100 pip move. You didn't need to catch all of the 100 pips, but I mean, you took at least something. I mean, there was targets over here to take. You could have traded to this high over here, this high right there. That high could have been a target. If you were trading down here, that could have been a high.
Was target the equal highs?
This one here.
No, the one with the purple line
This
above
one
the
here.
red one. Yes.
Okay, well, doesn't matter. Regardless, so if you enter down here and you put your stop there, like we said, 15 pips, just to this high, there's your 1 to 5, just like that. Don't be shy, Manuel. If you see something like that, put some skin in the game. You know, it's fine to be wrong. You know, no, it's not that one trade that you take, not now saying that you're a bad trader. You know, I take losses all the time. It changes my mindset no way, because I know that at some point I'm going to win, because that's just how it's going to play out. I've got the edge over the market. It's not that I don't run the market, I run my account, you know. So when you run your account, put some skin in the game, put some risk in there, prove yourself right or wrong. If you prove yourself wrong, so what? Mark it down, journal it, learn from the experience, put some skin in there. Even if you put like a portion of the risk you normally take on the trade, put something in there. And then what you might find is that, you know, the trade starts to run in profit, and you're right. It's easier to add to a winning trade than to take a new trade entirely. So if your objective was to take the highs here, and you entered down here and you saw it start of gapping up and voiding up over here, it's going to be easier for you to enter on some kind of retracement somewhere here, like in a New York session maybe, than it is to try and take a new trade over here. Manuel, do you follow?
Yes, I'm following you.
So it's easier to add to the position that's already in profit than it is to take a new trade entirely. So always, you know, it's fine to be wrong. We are here sitting every single day to be risk managers effectively. We're not trading. We're trading to not lose money. That's what we're doing. We're not trading to always win. We're trading to not lose money. So if we can play the game of capital preservation, we are at the end of the day always going to win, because if it as our number one goal to always preserve our capital, then we will always win, because we preserve our capital by taking trades. Not taking a trade, it's part of a strategy, but it can also hurt you to not take a trade, because if you don't take a trade here and you think about it and you're like, I'm really hesitant, I don't know, I'm unsure, but you do have a couple of things going for you, it's bullish, it's in a discount, you know, there's a SIBI, so there was a couple of things going for it there, and by not taking that trade, you actually miss out. So the next time you take a trade and you lose the next trade you take, you've hurt yourself and shot yourself in the foot, because this trade would have been a winning trade of whatever, 1 to 3, 1 to 5, whatever your stop loss was, regardless of the stop loss. By not taking that trade, by not executing, by hesitating on that trade, and not taking a trade as part of some kind of strategy, you've shot yourself in the foot because you weren't part of that profit. So if you know where I'm going with this, is that by not executing trades, you're actually potentially losing money also.
Yeah, that's true. It's relevant what you're saying. It's very true, because I saw those SMT occurring as just was waiting for the law to be taken. That's why the reason why I lose the trade. But I did journal it, so it will be part of my journaling, and I'll look into that in the future, because most of the times as a new traders, we have most to deal with fear on entering the trade, because we're not that experienced yet.
Fear of what? Fear of missing out, fear of losing, fear of being wrong. That is not fear, that is just hesitation. So
Yes.
if you can get over that hesitation and be more embraceful of what you perceive as emotion towards losing, right? Because all this fear, the so-called fear that you talk about, is just an emotion in your head, right? Or in your mind or in your body that you feel towards the market that is emotionless. The market is emotionless. You as a human are emotional, and your emotions interfere with your logical thinking part of your brain. So there comes a time where you have to think logically, or most of the time you have to think logically, and you need to embrace your emotions as part of us as humans. We can't, many people say, oh, just get rid of the emotion. You can't. You have to embrace that emotion, use it. Instead of looking where you can get out a trade, look for where you can add more. Embrace that feeling of uncertainty by knowing that at the end of the month or the end of the year, over a series of trades, you will be profitable. Always think of that edge. I've literally on my wall next to me here, I've got a list of 10 things that I read through every single day that are points. One of those points are, I don't know the outcome of every or any individual trade, but I know that over a series of trades, my edge will play out. And that is true. Every day I know this. So I don't know which trade's going to win and which trade's going to lose, but by not taking the trade, I am missing out. Not because of the fear of missing out, but by not taking the trade and not executing upon my strategy, I miss out. And that's just how it is. So we have to embrace that, and we have to put, as ICT calls it, skin in the game. And it's not always about getting the tightest stop loss. If you know that the directional bias for this session, okay, it doesn't have to be a daily bias, it could just be a session. So if you know the session bias for the day, it doesn't have to be the daily bias, but the session bias, you said that you wanted to take this swing highs or this equal highs or even this swing high, okay? Your session bias is bullish, okay? Then put some skin in the game. Don't be afraid of, maybe if you normally take like a 8 pip stop loss or a 5 pip stop loss, don't be afraid of taking 10 pip stop loss, 15 pip stop loss. Just put some skin in the game. Okay, always be a part of something that you perceive as your strategy. That's why learning what I'm teaching you with the price action models and things like that's going to hopefully assist you, because you know exactly what you need to look for, not just order blocks and voids and SMT and things. You can put it all together in some kind of recognizable pattern and associate it to the chart of something similar to occur every day or every second day, or at least sometimes occur according to the week, because we can sit days and learn models of what the price action is, and that model is never going to be identical. It will be similar, but it will never be identical. Okay, so price action repeats itself over and over again, but the manner or what it looks like is never an exact replica of what it looks like, only similar. Okay, so that's what I have to say about that, and that's hopefully a very long answer to your question, Emmanuel. But do you guys have anything else you want to ask regarding what I've now said about the double SMT, the RSMT, before I move on to something new?
No, nothing for me.
Okay, so very, very simple again. Okay, I'm going to teach you something else. Okay, all the trade setups I have is simple. They're not really super intricate. Like if you've ever looked at a Wyckoff schematic and you got phase 1, 2, 3, 4, upward thrust distribution, a creek, and then some kind of other stuff going on. There's nothing like that. A spring and a retest, there's nothing like that, okay? It's really simplified ICT teachings in a nutshell. Win or lose, put skin in the game, take the trade, and let the strategy play out. Simple, nothing too difficult. Okay, so what I'm going to show you now is also everything I show you is associated to SMT because SMT is a rule that I have, and so as Roger showed in a voice note, that every trade, 99% of all his trades is taken with SMT. Hey, Roger?
That's what he said.
Okay, well, I personally didn't know that he took 99% of all his trades as some SMT, but, you know, I've learned from him, so obviously we on the same wavelength, so that's at least something good then. Okay, so SMT is just a representation of some kind of manipulation going on, and if we understand what manipulation is, then it happens all the time, and if we can read manipulation, our skills at trading become much better. Hopefully you guys have seen it now that we've been so involved in SMT that you can see your price action recognition has greatly improved or should have greatly improved if you had already known ICT as opposed to now more intricately learning ICT. I think, Emmanuel, you knew ICT before you met me, right?
Yes, I knew ICT before I met you.
Okay, so then you're a good example. So from before you met me, right, and you knew ICT of like all of the stuff you had learned, but the focus being so much on SMT, has that helped you in any way?
That's a 200% different that I may say, because from what I used to see trade and how I used to see trade now is totally different, very, very different. Because I on those times I wasn't looking at a high time frame, like from daily, weekly to monthly. It was just 4 hour, 1 hour, maybe in 15 minutes, and not to know what's PDA is, what's IPDA is, what's a matrix is. I didn't know about all these stories. So it's a huge difference. It's a huge difference from day until now. I can say that
specifically to SMT though, has that helped you?
A lot, because now the trading style is different. Because without SMT, I used to use like a 4 hour order block as a stop loss. So we're talking about 50 pips, maybe 60 pips.
Yeah.
But reducing that risk, I can transform this 60 pips and actually one lot, a huge lot, so that I can have more profit than I used before.
Yes,
So
that's without increasing the risk. The risk is staying the same. It's
the same, yes.
because you can reduce the variation of price because you know there might be much less variation. So what the biggest difference for me when I learned ICT was I too went through the whole process of learning everything, but it was only when I came back to it for like the second or third time, and it's when one of his videos where he talks about the 3 characteristics of a trader, and one of those short-term, long-term, and intermediate characteristics is involving time and price, obviously, then some kind of SMT, COT data, seasonal tendency. So I was only looking at time and price, time of the day, London session, and then order blocks, voids, swing highs, lows, trying to turtle soup and buy swing highs and lows and sell them and whatever. I never knew that much emphasis about SMT, and it was only until I put the work in to improve the skill set of my SMT recognition that I saw the huge difference that I did. So all that SMT is really helping us with is by identifying how solid of a confirmation, let's say, an order block would be, because all very well we try and put a sell limit or trade an order block, but how likely would that order block be traded through, as opposed to now incorporating some kind of SMT by trading that order block. So that's the real sort of elevation in your trades that you should start to recognize, is by you've got the PDAs, you knew the PDAs, you knew what order blocks were, but you're elevating that now through the use of SMT. Okay, so that's what you guys should start to see. Okay, so I'm going to babble on any longer. I'm going to move on over here. I'm going to move on to this over here. This is a 1 hour chart pattern, and if you look over here in my price action models, this is what I refer to as just an SMT bounce. It is mostly a buy setup. Okay, it is mostly a day trade, and you can scalp it or day trade it. Okay, it's really just dependent on, if you're willing to hold it, or just want to be quick in and quick out. Also, with all my setups, most of them, they don't have large stop losses. Okay, unless you're sort of trading on something based off of a higher time frame. But this is the SMT bounce over here that I'm going to show you now. And it's really simple, really, really simple. So all you're going to need is a 1 hour chart. It's based off of particularly a buy setup, okay, on anything, okay, only. Okay, you can use it for a sell if you want to, but I personally buy. Okay, so this is a 1 hour setup, and with the 1 hour setup, the first thing you're going to need is SMT. Okay, on a 1 hour, and preferably it's going to be an SMT based off of swings over here. So swing over here, so like that would be a swing that was taken over here, maybe something like that, and then price turtle souped it over there. So there'd be SMT for a buy over here, or let's just draw it better, swing low, gets raided, and then you can see sort of that breaker mentality, that a turtle soups below that low, and then over here is where the liquidity would have been, and then price would have taken it. But obviously it doesn't have to be that structure. Obviously it could be equal lows. You guys know what all the patterns of SMT are. Obviously there's the something like that, that would be SMT. So there's, the SMT patterns. I don't need to go into detail of that. We need an SMT. It's not going to be based off of candlestick open, high, low, and close. It's going to be based off of swings, of swing lows, and rating liquidity, equal highs, high low, thing like that. Okay, so it's going to be based off of swings. Okay, so that's going to be number one. Let's just zoom out. And then number two is you're going to need the 15-minute chart. So you're going to need a 1 hour chart and a 15-minute chart. The 15-minute chart is going to be where you're going to find your IRP, which is your institutional reference point. So again, institutional reference point, hold high, if you want a rejection block or order block, and then void. Okay, and once that has been created, this is where we will look for entry. Really simple, nothing incredible about this. Okay, you're going to need a 1 hour SMT and a 15-minute institutional reference point. So when we get something like that, and we get a SMT over here like this, and we know over here that on the 1 hour chart this is an SMT, we are going to zoom in from this zone over here and start looking for 15-minute IRPs over here, and that's going to be maybe 15-minute equal lows, 15-minute order block, 15-minute void, 15-minute whatever. Okay, it doesn't have to be those three institutional reference points. Could be 15-minute break, 15-minute mitigation, 15-minute whatever. Okay, most of the time it's going to be the three institutional reference points, because it's going to give you your best entry with tightest stop loss. And it's really simple, guys. I can't explain this enough to you of how simple it is, because over here, if you zoomed into this price action over here, once you found your 1 hour SMT, you're likely to find that there is a down candle somewhere over here like this. Maybe it's got a large wick, maybe it doesn't. We don't know what's going to be there. And then there's going to be a preceding candle somewhere here that's going to show you some kind of displacement. Really simple, okay? And when it shows you that displacement, having shown the 1 hour SMT, we are wanting price to retrace back into this 15-minute IRP, and we are going to use the swing of that IRP as our stop loss. Really simple. So either you close the void of the 15-minute, you retest the order block, maybe this wick's a bit longer, I don't know. But we are trading from the 15-minute IRP, and we are using the 15-minute IRP as the swing low. It doesn't have to be. Sometimes that same candle is the same swing low as the 1 hour, and other times it's not. Okay? But we are using the 15-minute over here. So that's what we want to see. Before I go on, does anyone have any questions quickly?
No, so far this is easy to identify.
Yes, because it happens, I'd say, at least once a day if you're watching.
Yeah.
Okay, I don't really pay attention to selling because I've got like other sell setups, but specifically to buying. And obviously, if you know what the bias is, if you know there's some kind of PDA that should buy, then this is a good setup. Okay, so this is a 15-minute IRP with a 1 hour SMT. So you've got a confluence of a 1 hour SMT, and you've got a confirmation of a 15-minute IRP, be it a void, I don't know, it could be a vacuum block, could be whatever, okay? But know that that 15-minute zone, or as Roger loves, structure, then you can trade that IRP, okay? So maybe you find a shark fin or a whale mouth, okay, guys, you follow? Or some kind of bait over there. You're going to trade that structure. Okay, 15 minutes. So it's really simple. I'll show you a couple of examples here. Again, as with anything, there's risk involved, as with all trades. So because I'm showing you this doesn't mean it's going to win every time. Again, it's still related to a tight stop and a target. Remember that because we are trading an IRP, what is IRP? Is it internal range or external range?
ARP is internal.
Okay, so if we take, okay, great. So if we take the trade based off a 15-minute void close, 15-minute order block retest, 15-minute rejection block, okay, if we trade off one of those arrays, we are trading internal. So externally speaking on this 15-minute, where's our target going to be? External range, right?
That high, yeah.
Perfect.
They're
Yes,
all high.
sure, price may blast off to the moon, but again, don't be greedy. Take what you see, right? Okay, so that is our target, and obviously the distance from down here to up here, it might just be 20 pips, it might be 25 pips, it might be 35 pips, it might be 40 pips. Okay, I don't know, okay, because it's always going to be different, the price action. Maybe this void down here was massive. Maybe that's 100 pips. I don't know. Okay, but what I do know is if I see that anywhere in here, the 15-minute, maybe there was other swings that we didn't see, like this. Okay, maybe there was something else. Maybe there was some kind of equal high formation. That too can be a target. Okay, it is respective to the 15-minute, and you are looking for internal to external. So internal range based idea, trade setup, to an external range. The external on the 15-minute. 15-minute external range liquidity is going to be your target. So if I show you here quickly, let's just open this over here. So there's a little bit of rules here. So the requirements for this setup, obviously you need, like I say, a 1 hour SMT and a 15-minute IRP. trades are executed based on the 15-minute price action. Okay, so you're going to use the 15-minute chart. You can use lower time frame if you want. Okay, you're still going to mark up your 15 minutes. So your markups are going to be on the 1 hour and the 15 minute. You can enter off the 15 minute, or when price on the 1 minute, for example, if you were using the 1 minute, trade it into the 15-minute void closure, a 15-minute order block, and you're looking at 1 minute time frames, you know, you maybe find a better entry. Okay, it's all perception on your interaction with the charts. I can't tell you what to do. All I can tell you is that this is what the setup looks like. Look for it. How you enter is entirely up to you. It's a really simple setup. Okay, it happens at least once a day again. Okay, you can't catch all of these trades, but the more price action you learn, the better you'll become. Okay, so trades executed based on 15-minute RP, and obviously, like I say, it's optional to use a lower time frame to get a tightened stop loss. Okay, so maybe you might be able to, if you're using a 15-minute time frame, let's say 10, 15 pip stop loss, but if you use, say, a 1 minute, maybe you can shave off, you know, 5 pips, 8 pips, I don't know. You obviously, the lower you go, the more you'll be able to potentially shave off the stop loss. Okay, and obviously that increases your risk reward. Okay, it's not a high risk reward trade generally. It's generally like a 1 to 3. Okay, and that's just because it's sort of like a day kind of scalp session based trade. It's not like swing and take 1,000 pips kind of thing. It's just quick in out kind of thing. See the price action. If it's there, take the trade and exit it. You got your targets. It's not a massive trade, but it does happen quite frequently. And like I say here, you know, if you've got a 1 to 3, you can easily make that a 1 to 5 or more by tightening up that stop loss. But in order to get to that level of excellence, I would say, you need to practice the setup. You can't just, you know, expect 1 to 10 on these trades if you're not putting in the work. So first figure out the idea or the trade recognition of the pattern, then work on tightening up the stops. Okay, like for most setups, price must be traded from some kind of discount and some kind of premium range. Okay, so always, guys, whatever I'm showing you, always on some kind of basis of discount or premium buying or selling. For any trade setup, there must always be some associated discount or premium. It doesn't have to be the highest level of premium, but there must be some kind of premium, or it doesn't have to be the lowest level of discount, but some kind of discount. Okay, it's always better to understand that concept. So like I say here, it's internal range liquidity, so we can look to exit on like a 15-minute or a 30-minute, or even the hourly, okay, if you want. But generally 15 minutes is good, and you'll find a lot of exit points on a 15-minute chart. So you can look at a couple of setups over here. So like here on the side, we've got a 1 hour SMT. So really it's a waiting game, and you just say, well, okay, here's a 1 hour SMT, it's occurred, now just wait for the 15-minute to do the same thing. If it's a 1 hour SMT and it's going to buy, well, then wait for the price action. So it's sort of, there's a 1 hour SMT. Okay, great. I do nothing. Then I'll wait for the 15-minute to tell me that I should buy it. Really simple stuff, guys. It's not like intricate explanations. You get your SMT over here on your 1 hour, the same as on the left over here. Boom, price on this particular pair buys. Okay, I didn't put the pairs or the names of these things because it's irrelevant, because it's, you know, whatever you're trading, SMT is SMT. And over here we get the 1 hour SMT, and then it buys. Here's your 15-minute you can trade from. You could trade, you could see the expansion away from that area based on the 1 hour SMT, based on the 15-minute void. Price then comes in, retests this order block, doesn't close the void, and that is obviously gap risk. So you can decide of how tight of a stop you want to use here. Maybe you're able to get off on a 1 minute chart somewhere over here without closing the void. Other times you just enter and put your stop below, and the difference between doing that might be substantial, might be not substantial. We're talking maybe 10 pips or 5 pips. It's already a lower time frame, so it's not going to make huge differences to your risk reward, but obviously 10 pips versus 5 pips is double, so expect double the RR. Okay, So it's really simple, guys. I can't explain that enough. 1 hour SMT with a 15-minute IRP over here. And you can see that from here to here, maybe 1 to 2, 1 to 3, but obviously by tightening the stops, that is a much more significant move. Okay, so work on the process before tightening up the stops, because you want to be following the processing and executing the trades before tightening up the stops. Okay, over here, 1 hour SMT again. Over here you can see, and then this is actually a reverse over here. So this was the pound over here, and there's a 15-minute setup over here. Like I say, it is a buy setup, but obviously this can be done on a sell, and you would look to exit over here of this 15-minute external range liquidity. So we came back to the internal, but you guys can actually see from this is that in some way, everything I've taught you thus far, be it event horizon, double SMT, RSMT, in some way, everything I'm showing you is very similar in nature to one another. But by piecing things together and understanding everything, you actually can sort of assimilate your own trades, you know, build your own strategies. The more I show you this, the better you'll be at yourself, or hopefully. Another one over here, so we get a sell setup over here, and then basically price comes into this 15-minute. Now again, I said an IRP, so in this case price consolidates over here, and in this case it's a rejection block over here, and you'd have to place your stop just above over there. And you can see down here there was some equal lows as external range liquidity target on this 15-minute chart over here. So 1 hour SMT with a 15-minute confirmation to take the trade. It's really, really simple over here. Again, this is not GU, this is something else. I can't remember exactly what it was, but similar thing here. We get an SMT over here on the 1 hour, and once the 1 hour has been created, we watch the 15-minute unfold. Now you can watch this over here, and you can see there that there's an order block and a void over here, but price doesn't actually retest that void or that order block over there. And again, price makes actually another one over here. So our goal would be to, you know, take price lower into the liquidity over here as the external range, and our entry probably would have been on this order block over here with a stop above this order block over here. You just use the next PDA as your stop loss. You know, it doesn't always have to be an old high over here. You could use a mitigation block as your stop loss. You could use a breaker as your stop loss. You could use an order block as your stop loss. Those are PDAs, and as they are PDAs to enter a trade, they are PDAs to exit a trade. They are areas of significance. So stop loss placement can be used as those PDAs. You know, that's why you learn the PDAs. That's what their use cases are. Not just to enter, not just to exit, but a stop loss placement. Simple. Okay, does anyone have any questions? It's a rather simple technique. It's nothing substantial. So, you know, you either get it or you don't, and I can explain it a little bit more, draw it out again. Does anyone have any questions? I can send you guys this page as well if you want it.
Please, I was about to ask about for the link of something of this page, because I want this.
I think this page is actually shared over here. This whole page is shared, so you should be able to see this link over here. So if I say copy this web link and I paste it over here, you should be able to come and visit this on the website, like on this web page, which will take you all the way to the bottom over here, like lesson 9 to 11, and then you'll see it here. And then this over here will take you to this page I was just on over here. So you should,
thank you.
yeah, so you should have access to that. Okay, so where was I? Okay, so anyone else got any questions? Steve, maybe? I see your mic's unmuted. Are you going to say something? You want to ask something?
No.
Okay, great. Let's see. So the next one I'm going to teach you is, I'm going to teach you one more, and then we're going to do something else, which is this one. This is actually ICT himself is one of his favorite setups on his own, and you've probably witnessed this yourself. It's a Also, again, it's something similar to what we already know. Okay, it's a turtle soup IRP reversal. And this is, again, something you can buy or sell. Okay, it's really simple. Again, most of these are all simple. So it's going to look something, again, similar nature of price action. Maybe price over here was doing something like this, maybe consolidating a bit, then it decided to expand higher over here, maybe come a bit lower here, and then start to go higher again, and boom, it stopped. Now you're waiting for a trade setup. So we start to mark out our charts and we say, where's the liquidity? And then we say, well, below this area of consolidation sits liquidity. Below that swing low sits liquidity. We've taken out this liquidity over here, and this liquidity over here has been taken out. So if price decides to come down over here, okay, our expectation is that this liquidity point could be something of significance, okay, just by knowing that there's liquidity there, because as price moves higher here, stop losses gather as it moves higher, stop losses they gather, okay, so there's a lot of sell side liquidity building as price moves higher over here. So it is natural for price to want to come back here to target the sell side liquidity. Okay, now inside of the sell side liquidity is obviously sell side liquidity being sell stops, okay, but also stop losses, okay, for people who are buying. Okay, when I say people, I'm obviously referring to hedge funds, not you and me. I don't care about us. But as price moves higher, the stop losses gather here, and obviously the sell stops gather here. So that's the liquidity I'm talking about. And below here is, if price was to come in there and buy, would we say that's a turtle soup?
Yes.
Yes, yeah, we would. We would say that if price came in here below this low and bought up here, that is going to be a turtle soup. Okay, so this technique I'm explaining here, this turtle soup IRP reversal over here, is something that actually occurs quite regularly, and you've probably either mentioned it yourself to me or seen it yourself, because it is just something that regularly occurs. So this is part of your PDA, right? It's an old low, right? Correct?
Yeah, that's our old law.
Okay, so looking at the nature of this price action, Emmanuel, do you think that although there is that old low there, do you think that there's very likely to be some kind of other PDA associated to this? If this was a 1 hour chart, right? It's very likely that on the 4 hour or the daily, that there's going to be another PDA here, right? Correct?
Yeah, correct.
Okay, so then what we can do with this is that because there is liquidity here, we would like to associate this liquidity point with a PDA below this liquidity point. And that would be an IRP. So we got an IRP of the old low, and we look for an IRP over here below the old low, which is order block or void. Those two. So we've got an old low, which is the liquidity, and we've got an order block and a void sitting below the liquidity point over here. Make sense?
Makes sense.
So when price trades in here, okay, because at some point it will, okay, however it trades in there, we know that by trading in here, it is activating sell side liquidity, but at the same time, there could be a daily void here, there could be a weekly void here, there could be a 4 hour void here, there could be a, I don't know, a daily order block there, there could be a 4 hour order block there, but there must be some kind of IRP sitting below this institutional reference point of old low. And then it is What is the trend looking at this? It's going up, right? So we would want to buy, and based on where price stopped going higher over here to sort of where it broke out over here, this would be some kind of swing high and swing low. So there's a range in here. So by moving below this, it's already in a discount. There's an old low and there's an order block or a void down here. Also a very simple setup. This is a buy looking like a buy setup, but it's really the same thing in reverse if it was a sell setup. So obviously if price was doing something similar like this and it was trading lower here, and then it's trading higher, and then it starts to move away, and then it goes lower here, right? What is the overall direction? It's going lower, right? But obviously at some point price would want to go back higher, right? But over here would be liquidity, and over here would be liquidity of the range. Down here would be an old low that forms, and in the middle over here would be the 50% of the range, right? Like that. So above here would be your premium, okay? So again, premium discount always, as with any setup. And this is the IRP as price moves lower down here. More liquidity gathers. This line gets longer, more liquidity gathers. So it's actually, you know, this could be like a low resistance liquidity run. This could be multiple 4-hour candles, but you know, it's really dependent on the time frame that you're looking at. But that's an institutional reference point. It's a swing high with liquidity, and above the swing high with liquidity there must be somewhere here what, an OB or a void. Well, in this case it's going to be a SIBI because obviously it's bearish. So you are pairing up the old highs liquidity with the order block or void closure for lower prices. And again, if we take the trade above this high here, what kind of liquidity is this?
On the current range, that must be external.
Okay, you're correct. It's two perspectives of how you look at it. Okay, so it's external by going above this high, but in terms of the larger swing, it's internal. Okay,
It's internal, yes.
So it really, again, it depends on what is the bias for the long term, what time frame you're trading off. But you are correct. It's both internal and external. So if we are trading internal, we are going to look for external. And if we are going external, we are going internal. So if we trade it like this and price comes in there, we will take profits at some kind of internal range, order block, void closure, or we will take profits based on external range down here. But again, always pay yourself for the work that you do. So don't always believe that because the higher time frame says it's going to sell down, you don't know how down. So I always like to take profits at least on, you know, my particular pairs 50 pips, regardless of if I still think it's going to go lower. That's just like my breaking point. 50 pips is like the average range of any price swing on GU based on, you know, what I know. So always you're going to take profits. But this is a simple, again, trade setup, and it's something that is actually taught by ICT himself. And you guys should have seen this multiple times in the marketplace all the time. 4 hours dailies are exceptional trade setups. You know, it's not like this can be a 1 minute setup too, but it's when you use it on like a 4 hour daily, a 1 hour, obviously the pip range is quite substantial. So that's really dependent on, you know, what time frame you're going to be using to enter this on. Does anyone have any questions? Does anyone maybe not have seen this before ever? Has anyone not seen this type of price action occur?
I've seen some quite some time, but I wanted you to give us maybe an example, maybe on the chart, so to open our eyes more.
Good question. Let me see here. So let's just move this out the way here and pull up a chart. I think I have some for you. Oh, wait. I actually do have some. Right here.
I think we will see it in GU for
Okay, so this would be it then. So like here, we've got this particular time frame. So I didn't include a time frame here because it's fractal, right? So obviously, if you're going to do it from a 1 hour, you're going to get 1 hour results. If you're going to do it from a daily, you're going to get daily results, right? So obviously, the variation of pips is going to differ based on what time frame you're doing it on. But I would recommend that this is a day kind of setup, not like you can sculpt it, I guess the same structure would occur, but it's better to day trade it. That's my perspective. Day trade, intraday trade, maybe hold it for a night or two. So it's really dependent on what you're going to do. So what I wanted to show here was that you can see it makes a swing high up top here, and then price goes lower. Now what you'll see as price goes low, it makes like these sort of intermediate price swings here, right? But you can see how lower they are down in the range, right? Over here. Like this one's just sitting at 50%, then this one sits at 61%, and then this one sits at 79%. So you really want to obviously know where we are in the premium if we're going to sell. And then when it gets to an IRP above a swing point, obviously the IRP would be this order block or this void over here, but we are coupling up that IRP with a liquidity raid over here. And then we are looking for entry anywhere above that old high. So if we drew that old high out in time, we would try to want to be sellers above that old high. And how we would do that? Well, again, you know, I'm showing you more of a confirmation here than I'm showing you SMT, although SMT could occur anyway by going above that swing high, or when it's in the swing high by creating SMT in this zone. But you know how to use SMT, so it's not really essential for me to suggest that here because you know you should be doing that anyway. So that would, the sell setup would be over here. And obviously, depending on the time frame, if this was a daily chart and you took the trade here, before it got to the external range, it could have taken many days to get there, right? So again, it's, you know, perception. If this was the internal range or external range on another time frame, then you would be looking for internal range targets over here. Now, obviously, you know, 1 to 3, 1 to 5, 1 to 10. I mean, this move down here is pretty substantial. That could have been 1 to 100. I don't know, depending on your stop loss size. Okay, so this is going to end now. Okay, so like I said, it really depends on what time frame you use this on, but you need some kind of turtle soup to occur, be it buy or be it sell, turtle soup sell model, turtle soup buy model, and above that liquidity point, you need an IRP of an order block or a void, and then that's where you're going to be looking to take your entry. Okay, so there's a little bit of rules here. I'll show you some more setups now. There's a couple. Primarily, this trade is based off of one of the 3 IRPs, so old high, OB void. The entry is taken once price trades below the swing point for a turtle soup buy. Obviously, entry is taken when price trades below / above the point for a turtle soup sell model or turtle soup buy model. Okay, so obviously if you're buying or selling, then you know you're going to be waiting for that price swing to be raided. SMT can also be used, obviously, as usual, like I said, and the best entry for the setup is above or below the swing point at the IRP. Like I said, you must define a old high that has got liquidity, equal highs that got liquidity, a consolidation that's got liquidity. Okay, there must be some kind of turtle soup that would occur, and you will couple that with the IRP of the void or of the order block. TOD would be important, time of day. London kill zone, New York kill zone. Okay, those would be where you'd be looking for these setups to occur. Okay, so maybe early morning price comes into the RP, doesn't quite close the void, doesn't quite test the order block. Fine, no problem. Wait for the New York, wait for the London. Okay, time of day is essential for this setup. Okay, the setup is based off of a reversal pattern. So you can see the criteria of the way I trade is most of the time I'm trading reversal patterns. That is just me, okay? And that's just how I trade. But that doesn't mean that it is always counter trend, okay? So when you trade a reversal, it doesn't mean it's counter trend, okay? What it means is that if price is bullish overall and it's selling, you're looking for a buy reversal to get back in the trend. It doesn't mean that you're trying to trade against the trend. It could be counter trend trade, or it could be with the order flow. Okay, it really doesn't matter as long as you understand what kind of trader you are. Okay, I'm a person who likes to trade old highs and lows. That's just me. Okay, maybe you guys like something else. There's something for everyone. Okay, so it's not specific to, you know, whatever counter trend or trend following. Okay, it is meant to be of higher time frame nature, so 4 hour, daily, that kind of thing. That's where you're going to be looking for these setups mostly. It's not like a quick in and out kind of thing. You're going to have to maybe hold the trade for a day. You're going to have to hold the trade for a session. Okay, it's going to take some time for it to play out. Because we are trading and taking entry from an IRL, which is an institutional reference point, okay, our target should be external range liquidity. This external range liquidity can be on the same time frame as the IRP. So for example, the daily order block that we trade from, we are looking for daily old low to exit from. Okay, but again, if you've made 1 to 5 on the trade and you take nothing off because you're still waiting for external range liquidity, then you are a fool because you've taken nothing and you've paid yourself nothing. So always pay yourself something as and when the market makes it available to you. Like I say, profits must always be taken at 1 to 3, or 1 to 5. These are sort of good areas of likely where other IRPs would be nested inside. So like 4-hour voids, 4-hour order blocks, maybe daily voids, daily order blocks before the external range liquidity is taken. Okay, because it's not always that price will go to external range liquidity. Your analysis of the chart could be wrong, and price doesn't go to external range. You didn't take profits, and worst case, you get stopped out at break even, or you hit stop loss. So always pay yourself. Obviously, trading these with an SMT can significantly increase the risk rewards. Okay, but if you just maybe don't have time to always look for lower time frame SMT and you're taking some entries, you have a little bit of a bigger stop loss, but you're still going to make profit. 20 pips, 30 pips stop loss is fine. Price moves 60, 80 pips. That's still 1 to 3, 1 to 5. It's not unlikely that price moves that. If you're trading major markets, UJ, GU, EU, AU, USD CAD, all the majors, those are very liquid markets, right? So it's very unlikely that you're going to have to hold the trade for too long before, some kind of stop loss or take profits hit. Okay, so these are the setups, and they're pretty similar within nature. So here you can see price comes from a high and starts to void down. So what is this telling us? Well, the order flow is bearish because you can see it's gapping down. It's making expansion. Every time there's a green candle, it gets traded through. Low resistance liquidity run, and then finally price decides to trade lower. There is some liquidity above this high over here. This high is above the range is 50%, which puts it in a premium, and there is a void sitting over here. Institutional reference point of a void. Now notice there's a void here too. There's an order block up top here, but this is our expectation. So our expectation is that when an old high that has generated some liquidity by making this trend line over here, or lower highs has been created, this has a fair amount of liquidity sitting above it. So we can expect a turtle soup inside of this void. Not to close the void necessarily, but to grab the liquidity and make a run for it because of the order flow had been bearish. This could be 1 hour. This could have been a 4 hour. It's likely it was a 4 hour, but you know, anything of a higher time frame nature, 1 hour, 4 hour daily, this could be a weekly. Okay, same rule would apply. Turtle soup, IRP reversal. Simple. You're turtle souping an old high or low with an IRP as a confirmation. IRP being a void or an order block. And then you're getting in the trend basically, or counter trend really. Most of the time it's with the trend. Like I said, you should have established some kind of bias and looking for further expansion within that bias. And then you are taking the trade. Obviously, by coming above this high or while we are in this high, it's not on this chart right now, but it's very likely that within somewhere here, there could have been an SMT here on a lower time frame for you to help you to get an entry. So instead of taking, like Emmanuel said, you know, this trade with like a 50 pip stop loss above this high over here, you know, you could use market just above the high, narrow down that stop loss. So even if it was, you know, 30 pips, it's better to have 30 pips above this high than 300 pips above that high and then wait for 900 pips to get 1 to 3. Okay, so but again, it's about the process and not always about the stop loss. Okay, if you can make money with any kind of stop loss.
Yeah, this is pretty similar, like one of the photos, the ones of the screenshot that you sent us, but the difference that your one was on lower time frame, where that special happened on the news release when they make a big expansion, then you wait for the low to be the high to be taken. Or not one of the photos that you sent us on the chart, where there's this void on 61.8%, the high, above the high. Retreat, yeah.
Yeah, well, again, it's not always about closing that void, right? Because
The void, yes.
it's not always about that, you know. And the more we realize that, the more we see it in price. Yes, sure, sometimes price will close that void, and other times it won't. But we must have the anticipation that when we are inside of the sell side liquidity, or in this case, the buy side liquidity, and we've retraced a little bit, there could be a turtle soup there. And the way we would maybe know if there's a turtle soup there is that this could be SMT. So SMT obviously helps you in this, although it's not on this chart, but it's assumed that all trades you take have some kind of SMT in them. If we are following what ICT does 99% of the time, right? Okay, here we go. Here's a buy example, right? So here, pretty simple stuff, right? So we can see an order block. We've void up over here. It expands higher. You can see it makes a low resistance liquidity run. Over here, it again voids up, low resistance liquidity run. It stops, pauses, and goes lower. What's gathered here? Liquidity and liquidity, sort of relative equal lows. And you can see from this low to this high, there's some kind of discount, and you can see it start to expand lower, and only below the 50% do they actually buy. So again, we are coupling up this turtle soup with this liquidity below this low because of all of this higher lows. There'd be some kind of trend line here. As price moves higher, there'd be a point of liquidation over here. So it's natural for price to come into a discount, take the liquidity below, and either retest an order block or close a void. In this case, it did both, retest an order block and close a void. Now, obviously, it doesn't always do that, as we know, because price may have just come below this low at like 70.5%, like this one, and not close the void. But in this case, it closed the void. And that happened pretty quickly on this 4-hour time frame, I think. So, and this pattern repeats itself. Obviously, if you're looking at it from a 4-hour or a daily perspective, the trades are few and far between. But obviously, when you are trading in the order flow or in the directional bias of where the market is trending, it's pretty large, you know, this expansion. Okay. Again, over here, similar situation. Where has price come from? Well, it's come from a low, it went to a high, it came from a low, back up to a high. So that puts price in a premium, and then it sells off, making this range over here by taking this low and possibly maybe taking this low here too. Then price retraces and consolidates a bit. What does it do? It makes equal highs here. Pretty easy to spot. Price comes in, turtle soups outside of that liquidity while trading into a void. Now notice that it could have closed that void, but it didn't. Maybe there was something else on the daily that we're missing here. If this is a 4-hour chart, maybe there's a daily order block there. Again, that's why the more PDAs you have, the better. Maybe there was something else there. But in terms of just simplification, this is what we see. It trades into a void, turtle soups the high, and maybe by trading up above these highs, there was SMT here. We don't know. But there could have been. Hopefully there was. Pretty simple stuff. Turtle soup, RP reversal, order block or void. Nothing to it. Buy or sell. Happens all the time. If you're doing it 4-hour daily, like I say, you're going to have to wait for it, but it will form. You just be patient. Tomorrow's Monday, guys, so, you know, all these things I'm showing you, look for them. Doesn't mean they're going to just happen all on Monday. You got the whole week for them to occur. That's why you never rush into a Friday. Monday, rather. Similar situation here. You're going to mark up where's price come from. It's come from a low, moved much higher, came down to a low, rallied from the discount of this newly created range, and boom, it took the high over there. We didn't take that trade, but price then traded lower, and when it traded below that swing low, we know that by moving higher here, generates liquidity, there's a void, and boom, price closed that void. And when it closed that void, you use SMT maybe to help you or assist you with entry. So instead of a 20 pip or a 30 pip, you got a 15 pip or a 10 pip. SMT greatly helps us to amplify our trading, if you will. It's a really simple setup. Anyone have any questions? And then there was silence. Can you all hear me?
Nothing from
No questions from my side. Thanks.
Okay, well, if there's no questions, then I have one more to show you. I wasn't going to show it to you because I didn't think there was going to be enough time, but it appears there is enough time. I don't think I put it in here. So I was only going to show you those additional 3 over here. So there is time. So let me show you this. But okay, it's maybe not something that you wanted, because I saw that you guys voted for sort of more day trades, but it's is it this one I wanted to show you maybe? Yeah, this one. Okay, I'm gonna just put this in there.
Please don't forget to show us the dollar as well.
So show you what?
The drawn liquidity.
Well, you already know what that is. That's a simple setup. It's basically when price is drawn to some kind of equal highs or lows.
Yeah, we know about that. Maybe there's something specific that we don't know.
Oh, maybe a story for another time, Emmanuel.
No problem.
But I feel like this one's quite important, so I'm going to show it to you. Okay, so this one also, simple stuff. Okay, it's more of a, how can I say, a longer term trade. Okay, because these trades based on weekly expansions. Okay, we are trading internal range liquidity of the weekly void and looking to exit the trade at 4-hour and daily external range liquidities. The setup on average, okay, if you're trading a weekly chart or a daily chart, 4-hour chart, naturally you are trading directional bias more so than you are trading day or scalp trading, right? So you have to hold the trade longer. Naturally your stop loss would be a little bit larger than usual, but this is more for someone who doesn't have the time to always day trade, who still wants to trade, who among us here is likely, because most of us here have day jobs, okay? So it's a very nice setup and it doesn't require a lot of effort. It just really requires you to be attentive to the weekly and daily time frames and possibly the 4 hours. And the setup slowly unfolds. It's not like, oh, missed it kind of thing. And also the stop loss again is not that important. It's more about the directional bias and the willingness to be patient, and it can still pay. Obviously, again, if you're willing to wait and you have the time to perfect the entry, then instead of like a 1 to 3 or 1 to 5 as the trade setup would normally give, obviously that would be substantially increased, but still patience would need to be paid out. Okay, it's just like I say, it's a slower entry technique, so you will miss less trades, but you will need to have more patience for price to play out because it's a weekly time frame. Okay, so let me just quickly draw it out for you. It's pretty simple stuff. Again, nothing substantial. So let's look at it from this perspective over here. So obviously price would have had to have shown us some kind of bias on a weekly, right? Okay, and slowly but surely price moves away from a specific area. So it's very likely that over here would be some kind of down candle, maybe. Oopsie. Over there like that. Forgive my terrible drawings. But over here, price would have likely expanded. Okay, and again, it's not about catching the ultimate best entry. Okay, and then price wicks, and then again, it gaps up like this. What would this be, guys? What would this be on the weekly chart? What would that be?
This is weekly chart, is it? Weekly thing.
Yeah, what would that be? This old high here, what would that be? If price had closed here and this new week opens, yeah, like this, and it starts to go
So
low. What is this? A what?
BC.
Okay, right. So it's a BC, right? Okay, so what is our expectation?
We expect the price to trade to that BC and we take an entry.
Okay, so I'm not showing us the sell into the BC. I'm showing us the buy from the BC, because the expansion is in a bullish direction, right?
Yes.
So our anticipation is that we don't want to sell, we want to buy, but in order for us to buy, we have to wait. Okay, so the general rule here is that we wait, and we could do two things. Either we set a very low lotted buy limit to tell us that we're in the trade, or if you don't want to do that, you set an alert at that price level so that price has gotten there. Okay, do we all follow? Because it is our anticipation that when it gets to this buy side imbalance, that it's going to expand again higher, right? And the liquidity over here would be the external range we would like to target. So when we enter somewhere down here, it is our goal to take profit over here. Okay, at the top of that daily or 4-hour swing high or low that we find on a particular time frame, or whatever comes first, either that swing high that we find, or maybe like 1 to 3, 1 to 5. Okay, whichever would come first, but always we're still going to pay ourselves. Okay, so that is the requirement of this trade. Obviously, if we're doing it from a reverse angle and it's a sell setup, then these candles are just reversed to bearish candles and we're trying to trade the SIBI close for further expansion lower, right?
Yeah.
Okay, so does anyone right now, okay, I'm not even going to ask the question, let me just do it anyway. What is the difference between a sell limit and a sell stop? Does anyone know? Or does anyone not know?
Yes, I have a pretty a little bit idea of that.
So, sorry, what do you say?
I have an idea of that.
Oh, you do have an idea. Okay, wait, before you say anything, does anyone not know? Anyone right now in this chat or this Zoom call that doesn't know what a sell stop is? I'm sure we all know what a sell limit is. Does anyone not know what a sell stop is? Okay, great. I'm going to assume that we all know what a sell stop is. Okay, so quickly, obviously, if we have an order block over here, and this is a bearish order block like this, something like that, maybe a wick here, and we place a sell limit over here while price is still at this level over here, we anticipate that when price comes in there, our trade is activated with our stop over here above the high, like that. And the trade is then activated. That is a sell limit over here. Obviously, with a sell stop, it works a little bit different. So in the same structure, if we have the same sort of setup, we have a bullish candle and then a bearish order block like this. And price obviously over here, this is our order block, that's our high over here, like that and like this. Old high, obviously all the same, PDA is going to stay the same, except the only difference with a sell stop now is that price is already trading higher like this, and it's now in the order block and it's above the order block, but now you set a sell stop over here. So only when price trades through this zone, boom, does the trade then get activated with your initial sell stop and stop loss wherever you had placed it, probably above that high. So the difference is that when price trades through the sell stop, it activates, and when price trades to the sell limit, it activates. That's the difference. Obviously, it's different for if you're buying, buy limit, sell limit, or buy limit and buy stop. But that is the difference. Okay, so that is what I needed to tell you. And if anyone else that's going to watch this video didn't know that, hopefully they know it now. If you don't, go YouTube it. I'm not going to explain more about that because we all should know anyway. So that's the difference. And for this setup, we are going to use buy stops and sell stops. Okay, because again, we are not too worried about the size of the stop loss, but rather the directional bias and where price is going, obviously to exit our trade. Okay, so whether price is giving you a sell stop or a buy stop of 50 pip stop loss, 30 pip stop loss, regardless, it is based off of higher time frame. And this, not everyone's cup of tea, but it is a really good setup, okay, if I don't say so myself. And when it gets there, so when price gets to this BISI, we're going to draw this out in time. And when the price action returns to this BISI over here on the weekly, we're going to zoom in there, right there on that BISI, and we are going to use either the 4-hour or the 1 hour. Okay, and before an order block is created that would be bullish, we need a down candle, right? Correct? Correct?
Yes, absolutely.
Okay, so we are looking for, once price has closed this BISI or this imbalance on the weekly, for a bearish candle. Why? Because we are going to use it as a buy stop, and we are going to place the buy stop as if it were an order block over here with our stop below here. So only when price trades through it does our buy stop get activated. And obviously, if more candles still sell over here like this, and we've already placed the buy stop, we just drag the buy stop down like this, and then the new buy stop will be here on the next bearish candle. So you really are just paying attention to 1 hour candles or 4 hour candles, depending on your cup of tea. Obviously, think of it from this perspective. Obviously, if you use a 1 hour, there's more chance to tighten up the stop, get larger RR, but at the same time stop you out because, you know, maybe price dipped a little bit below in the next session and then voided you out. Okay, sometimes you get away with it, sometimes you won't. So 1 hour and 4 hour would be your entry off of the weekly imbalance, and you're placing a buy stop above the candle to be taken into the trade. And more often than not, price literally just parabolically moves away from there. You guys maybe have seen something like that, I'm sure. Has anyone not seen this type of price action? Okay, based on the silence, I'm sure you have. Does everyone understand what to do here? Hopefully you do. If you don't, speak up.
Oh, can you please repeat again? I couldn't get it good. This, yes.
Okay, so with this setup, we are looking to identify first some kind of directional bias, right? So like expansion in a particular direction, okay? And with that expansion in a particular direction on a weekly chart, there's going to be imbalance, right? There's going to be some kind of BISI that you find, okay? And it doesn't have to be this BISI down here. It just has to be this one, the nearest one, okay? And when it gets there, you are going into the lower time frame of 4 hour or 1 hour at the closure of the BISI, because you've set the alert, right? Okay, you've set an alert to remind you that this BISI is closed. And you're using the 4 hour or 1 hour down candle highs as a buy stop placement. So at every 1 hour close or 4 hour close, you are literally placing a buy stop above those with a breakout, basically. You'll know where to place your stop based on as the price is moving on the 1 hour or the 4 hour chart, because your stop will change. If the price moves lower, it will then move to this swing low when the candle trades lower. At some point, price is going to do that. Not always. Obviously, you're going to lose trades, and then maybe it will reverse here. But more often than not, if you've picked something that is weekly and it closes a void, and you've put a buy stop, you're going to see pretty good trades. Okay, so I'm going to move on here. It's literally, I say, void duplication, because of the reason you'll see now is that when it hits the weekly imbalance, it's literally going to void in the opposite direction. Well, you know, in the direction of the weekly expansion anyway. Okay, so it's a slower technique and you'll miss less trades. Reason is because it takes a while to close the imbalance, right? So, you know, if you set the alert, it might take 3 days for it to get there. And even when it gets there, it's not like you're missing out immediately, because you still need a 1 hour candle close or a 4 hour candle close to place some kind of buy stop at that zone. Okay, so you can see here, we have a weekly buy-side imbalance, okay? And based on where prices come from and traded lower, it is here that we pay attention. So we set an alert when it gets there. This candle closes, this down candle, and we immediately place a buy stop over there on this candle here, not this green candle, because we don't know this green candle is the low at the open of that candle. We don't know that, so we place the stop loss below that low with a buy stop above there, and you can see from there it just goes parabolic over here. Generally it's a 1 to 3 trade, but obviously if you're doing it from a 1 hour, you're going to be able to get maybe 1 to 5 over here. Again, it takes a while to play out, but you know, once you've seen this play out and you're in the trade, I mean, you can use other PDAs here to get you in the trade as well, you know, or add more to the trade. So it's something that's more, I'd say, intraday, maybe weekly range / swing trading, if you will. But when it pays pretty well. Here's another one. So again, 4-hour chart. Entering from a 4-hour chart, price comes from a high down to a low and moves away. You place your buy stop above this candle over here. You literally have 2 times where you just wait. So you see here, there's a down candle. It makes a low here and then still doesn't go higher than this high here. So it gives you literally 8 hours before price does anything over here. 4 hours, 4 hours. That's 8 hours of just sitting in this range before it trades high here. So you can decide where to place a buy stop here, but obviously it will be above this candle, down candle's high. And then when it trades higher, you can see there's a retracement here, but obviously we're not so worried about tightening the stops because it's a 4-hour time frame. We're going to put it below here and we're going to target 1 to 3. Simple stuff. Again, it's in a discount based on this range. We're in a weekly imbalance. Price should buy, and we are just patient for when it does. Okay, here is the same trade I just showed you on this 4-hour here, but from a 1-hour perspective. Price makes a high, moves down to the low, closes this purple line, which is our weekly buy-side imbalance. And what do we do with this? Well, you can see here that we were able to tighten up the stop here because we used a 1 hour. So we have to be more attentive to the chart because now instead of waiting 8 hours, we waited 1, 2, 3, 4. And on the 5th hour, we had a trade through this down close candle over here. And then the buy stop was activated. Your stop loss obviously will be the placement below this low over here. That's what you should see, is you can see this 1-hour time frame is expanding, which is again why I call this setup void duplication, because literally weekly is voiding up, and then from that closure of that void, it's voiding up again. So it's literally duplicating the voids just on a lower time frame. And that's what we expect from something that is bullish. Retail traders don't know this stuff because they're too busy looking at if this is a bounce off a 200 moving average and is there any kind of trend line they can attach to this. They don't know this stuff. And if they do, well, they don't know how to use it. Okay, so this is simple stuff. We're placing buy stops as the primary reason or method for entry. If you understand what a buy stop is, if you don't, go Google it or YouTube it. You'll get a quick answer. But that is how we enter these trades. Weekly imbalance closure and price voids up. Obviously, you can see from the 4-hour, you'd get only a 3R because your stop loss would be bigger. But because on a 1-hour, you can tighten up that stop using the same entry technique, same reason to take the trade. Boom, you trade and you get 1 to 5 from instead of a 1 to 3. Same sort of situation here. This is USD CAD again. BISI, 1 week. Price makes a high, trades down into the low. Again, it closes the BISI to the pip, but it doesn't matter. We don't care about that. We are waiting for price to move away for us to get taken into the trade. We want to see void duplication. And you place your buy stop on order block, which is on this 4 hour right there. And then boom, you're taken in. So literally 4, 8, 12 hours, probably more with this down candle here, before you are even in the trade. So you have to wait 4 to 12 hours, but you would already have placed your buy stop because this low would have been made in this candle. So 4, 8, and on the 10th or 12th hour, you could have placed a buy stop with your stop just below, expecting 1 to 3. Obviously, our goal is to target external range liquidity, but that doesn't always pan out. And then obviously same trade, just from a 1 hour perspective, you can see tighten up your stop using the last down candle's high as a buy stop entry, and you can see you get 1 to 5 easier than you do on the above chart. So by going down one time frame, you can, significantly increase. It's a very good setup, guys. Like if you want to take one, sort of swing trade or weekly range trade, because maybe you're day trading most of the time, but trades like this, you just be patient and it pays you. There's nothing wrong with taking these. You don't have to just always day trade or scalp. There's one more here. Oh, that's the same trade. Sorry, no, it isn't. This is a different one. This is USD CAD again, weekly BISI, 4 hour down candle, and when it trades through that down candle, you would have been activated in. And even with this retracement, you would have been safe because your stop loss is below the swing low with an expectation of 1 to 3 on a 4 hour. And then I think there's a 1 hour here as well, where you use the 1 hour buy stop entry and boom, you get taken in. But obviously, because it's 1 hour, instead of 1 to 3, you get 1 to 5, and possibly more because you can see how bullish it was, and that would have been your ultimate goal. But pay yourself. Maybe above that high, if you see it just voiding up like that, just above that high, that would have been like 1 to 7 maybe. But you can see how these play out, guys. It's literally boom or bust kind of thing. You're either wrong or you're not, and they slow-paced trades, not like you're going to miss them. They take a while to unfold, and they're very good trades. You guys should investigate them. So I've given you guys a lot for tonight. I'm going to call it a night, and have a good.
Okay, so let's see here. Okay, anyone hear me? Screen recorder. Yes, I'm recording. Okay, there we go. So like I say, it's structured SMT. Okay, we all know what SMT is, how it looks, where to find it, what to do with it, and it's 2 o'clock now, so that means the central bank's dealers range has ended. Okay, so we're not caring about that. It's structure based. Okay, so what you see is I've posted in the group here these lessons that you can go watch. So obviously, if you don't know what a breaker is, okay, or you want to refresh, go watch the video. ICT has done us a service by posting it all on YouTube. And then here's my notes of the breaker, or how to find the breaker. Okay, so that is going to be a breaker. Okay, so you can go watch that, look at the notes. Then there's also going to be a mitigation, and we're going to look at the mitigation. Okay, so you must obviously understand what a breaker is, how to see it, and you must understand what a mitigation is and how to see it. Otherwise, this, what I'm going to explain, is not going to really help you in any way unless you understand those two core mechanics or concepts. Okay, so let's just have a quick recap ourselves here. Very easy. Okay, if we look at a breaker, we are going to say that the very similar to mitigation, the difference with a breaker is how the structure would be the turtle soup. Okay, and that breaks the swing high or low that generated the turtle soup. Okay, so obviously with a breaker, it's very important that there is some kind of liquidity that needs to be taken. Okay, that's the main difference with a breaker. Okay, so obviously if we look at how that would look, We've got sort of maybe some liquidity over here that's either consolidating or whatever the case is. Okay, so there'd be liquidity over here like this, and over here we'd have a move higher and a move lower. So we are looking for the swing low of that move, okay, which would be possibly over here. And then this would be your breaker over here. Okay, it really depends on what time frame you look at it, because if you look at it from a lower time frame, the breaker might be here. Okay, but it really depends on what time frame you're looking at. So if you're looking at it from a lower time frame, the breaker is going to be at number 1 over here. But if you look at it, say from a 4-hour or another time frame, the breaker might be over here at number 2. The important part about the takeaway from a breaker is that it is the swing low over here, depending on which time frame you use, that grab the liquidity up top here. Okay, so that is our breaker. So we would anticipate that if our breaker is at one of these levels of number 2 or number 1 over here, that when price stops going lower over here and heads back higher, that this would be just a short return to breaker over here. This is a return to breaker, okay, RTB, if you will. Okay, so that is a return to breaker. So our understanding of the breaker is that there must be a liquidity grab, and then the structure of the market has broken. Okay, and that is our breaker. So I'm not going to go too much detail into the breaker, and then obviously it's just reversed if price is doing something like that as well, and there's liquidity over here, and then it breaks the liquidity, and then boom, price rallies, you know, something like that in reverse, right? Here's your liquidity, and depending on what time frame it's going to be at this level or this level. Okay, same thing, but just reversed. Number 2 or number 1, or rather number 1 or number 2. Okay, that's basically your breaker. Does anyone have any questions quickly about what I've just said?
From my side, thanks, sir.
Anyone else? No questions? Quickly? Yes, no?
No.
Okay, so if we understand what the breaker is, let's quickly look at the mitigation. The mitigation is a move high over here and then a move low. So we've made a high, so there's liquidity above this high, and price makes a swing low at the bottom over here, and price moves away from that swing high to that swing low, and it generates liquidity both on the upside and the downside. And the fact that price makes a failure swing by trading here, this is what we refer to as the mitigation block. Okay, so really your mitigation is over here in this area here, so that if price returns back there, that is your mitigation over there. Okay, and then obviously in reverse, over here we make a low like this, price trades higher and makes a failure swing, so your liquidity over here and over here, same thing there and there. Price fails to take out the low and trades higher, and over here is our mitigation over there, so that if price comes back, we are looking to potentially take a trade at the retest of this mitigation for high prices or lower prices if we were selling. Okay, so that is breaker and mitigation. Okay, you guys can go and look at the nitty-gritties and watch the ICT videos of that. I'm not going to spend a lot of time on this. Okay, what I'm going to spend time on is the SMT surrounding the nature of this price action. Okay, so that's where I am going to spend time, because this is the relevant stuff. So number 1, number 2, and number 3. Okay, now you're probably going to say 1, 2, and 3, old high, order block, and void. Okay, 3
Void.
institutional reference points. But I'm not talking about that. I'm going to say this is liquidity.
Hold the high.
Okay, so this is liquidity. Number 2 is what?
Orderblocks and
Structure.
Okay.
Right?
institutional order flow.
That's it. Then number 3 is what?
Sorry, I missed it. What was the question? Okay.
Structure.
Structure. Okay, so liquidity, order flow, structure.
Structure.
Okay, so now if we understand, obviously number 1 and 3 can still be order block, old high, void, etc., but for the purpose of what I'm explaining here, this is what we are thinking about. Liquidity first, then the order flow because of the liquidity, and then as a byproduct of liquidity and order flow, structure is created, right?
Yeah.
Does
Yes.
everyone agree? Does anyone disagree?
Agree.
Okay, so if we understand this, okay, and we understand mitigation and we understand breaker, then applying SMT to this nature of this price action is actually pretty easy, okay, because all we are going to need is the following. So we're going to get a high, and then it's going to make a failure swing like this, and boom, there we go. What is that?
Failure.
Okay, so this is a mitigation, right?
Yeah.
So the principle
Yeah,
behind this entry, okay, this entry technique surrounding SMT, okay, is guided by the structure element of things. So if we know up top over here is the liquidity and the order flow over here has potentially changed on like a 5 minute, a 15 minute, a 1 hour, a 4 hour, whatever time frame you're looking at, okay, because this mitigation we're looking at here can be fractal of any time frame, right? Okay, so we are saying that here has created a mitigation by trading through that failure swing high, and this swing low has now been traded through here. So does anyone have a clue of how we would anticipate or use SMT with this price?
OHLC SMT of that mitigation block.
Yes, there could be SMT, true. There could be very well SMT from this swing high to this swing high, right?
No. What I'm saying is there's a mitigation block formed, right?
Yes.
In the So to enter trade on this, right? We can see OHLC mitigation on that mitigation block.
Yes, that's true. We can, okay, because we already now have this mitigation that has taken place over here. So whether or not SMT occurred from this 2 swing points is irrelevant, okay? Just by looking at EU or GU or whatever you're doing SMT with, we can see that this mitigation has been created. So what we can then do is saying, okay, this mitigation has been created, and from having created this mitigation, then we can pay attention to the price action that unfolds after the mitigation has occurred. Okay, and this is the nice thing, guys, is that I've shown you a entry technique using that event horizon, and now I'm giving you this as well. But obviously, if the more you understand, the more you can use in all of your trade examples, okay, or trade setups or whatever you want to do. The more you know, the better. Okay, it's just how you use the information. So once the mitigation has occurred, then we can go and look for SMT. And how we will do that is by doing the following. So obviously, if this is EU or GU over here, we would anticipate bearish price action, right, for selling, correct? Yes, no?
Yeah.
Okay, so then the same move, okay, if it is symmetrical, okay, which is fine for price to be symmetrical. We had the same occur in the DXY, right?
Okay. Yeah.
So it is symmetrical because both of them have created some kind of mitigation.
Correct.
Okay, there doesn't have to be SMT over here and over here for this to work. We just have to get a mitigation, and we have one. So now our structure element has changed. Okay, so going back to this over here, liquidity, where's the liquidity? Well, it's below this low. Where's the order flow? Probably over here, between this move over here to here. Order block, void, etc., right? So that's where your IOF comes in, over here. Where is the structure? The structure, so let's label this. This is number 1 over here where the liquidity is, number 2, and in between here and here is 0.3. So we are trading number 3 now. We're trading structure. Okay, so if the structure has been created, there shouldn't be a need for price to come back to number 1, which is liquidity, because of the structure, right? Now, I'm not a fan of mitigation or breakers, but they do work, okay? So we can't deny that. And by doing this, we are now looking for a sell on the foreign asset, be it EU or GU, right? Or AU or whatever you're trading, okay? For myself, it's going to be one of these two, okay? Up top here. So we're looking for a bearish move. So how we can do this is by watching now. We're anticipating a bearish move, which would be bullish on the DXY, right? Because now we've both got a breaker or a mitigation on this zone, so that when price comes back into this zone, like we expect, we are now waiting for SMT to occur anywhere, right?
Yeah.
So that SMT could be something like this, where price comes in here and this one goes over here.
Right. Yeah.
So here we have SMT and here we have SMT.
Yeah.
Or we have something like this. Right, so there could be SMT there too. Or here. It's going to be easier when I show it to you on the charts, but this is the nature of this whole structured SMT basically. You're wanting a breaker or you're wanting a mitigation to occur, either to buy or to sell. Obviously, this I'm showing you a sell here, but it's just reversed for a buy. It's the same thing. The structure has told you it would like to sell in this case, and then you are looking for a reason to get in the trade. Where can you get in? The confirmation is what?
Order blocks,
Mitigation.
void.
Well, in this
Yes,
case, the confirmation is the breaker, right? Or the mitigation.
Yeah,
Mitigation block. Yeah.
mitigation.
Okay, so then the confluence would be the SMT part of things. So if we understand this, does
The
anyone
same thing
not?
happening in GU now.
Sorry?
No, the same thing is happening in GU now.
The same thing is happening in GU now. Okay, let's have a look here.
Now, yeah.
Okay, well, the same thing did happen in GU, which is, just coincidence that I was going to show you this anyway. Okay. Quickly, how do I remove all of these markings on my chart here without deleting them? Anyone? Is it this thing?
Delete button. Yeah. Yeah.
Okay. So let's look at this, right? What do we see here? Come, guys, what do we
Failure
see?
swing. Failure swing.
Okay, we've actually got two. We took this high from this swing low by moving higher here, and then the market broke, right?
Yeah. Yeah.
So
Yeah.
this would be what?
Breaker.
Ah, greatness.
It will come. It will come.
Okay, well, anyway, that's the breaker, right, over here. It's not all the time that price creates a breaker and a mitigation. I'm not showing that. I'm showing one or the other, or sometimes both. Okay, but generally, what comes first, breaker or mitigation?
It's I mean, it's breaker first and then mitigation.
Yes, sometimes one, sometimes the other. We don't know which one, sometimes both.
Yeah.
In this case, it's both, but most of the time it's breaker first and then mitigation, or mitigation only, or breaker only. Okay, so what I'm showing here is the fact that the market broke, okay, by trading lower here. So there's our first break of structure here. We are then saying that because the breaker was created here, that somewhere here, over here, is going to be a SMT, right? Right?
Yes, yes, yes.
So where's the SMT?
There is, yeah, GU is higher low.
Exactly.
Sorry,
low.
low or high.
Yeah, low or high. Okay, so there was that one.
Yeah.
Okay, there was that one. Now that's off of a breaker. Okay.
Okay.
We are lucky though, because not only was there a breaker, there was also mitigation. There was mitigation here, right? Because this swing low failed to take out this swing high, right? Yes?
Yeah, yes, yes. Correct, correct, yeah.
So you could have either taken the trade over here or over here, ones that had traded through here and started to retrace. You are looking for SMT at the mitigation or at the breaker. Does this make sense, guys?
In 1 hour, 1 minute also, it's showing the same story now.
Okay, so this is a 1 hour breaker or 1 hour mitigation. So that means if you are doing it from a 1 hour, you're going to go down to a lower time frame and look for SMT because the breaker is on a 1 hour. But the same rule would apply if it was a 4 hour. If this is a 4 hour breaker, or if this was a 4 hour chart, the same rule would apply. You'd use a lower time frame for SMT because you believe that the confirmation of a breaker or a mitigation has the reason to sell, and then you are looking for SMT once that has changed. Does everyone understand?
Yeah.
So not only was there this over here where, remember this morning I said there was this void fill over here on the DXY, okay? That's one maybe, okay? But if you didn't know what this was, the other way you would trade it is that, well, if you look at this mitigation over here and here, okay, you are anticipating price to be bearish, so that when it returns back inside here on the lower time frame, you are looking for SMT. Because the mitigation is telling you it's selling, or the breaker is telling you it's selling. But let's forget the breaker because we missed that. That was before the London session. But after the London session, or during the London session, we had the mitigation to trade off over here. Okay, now I don't trade Asia session, so I missed the breaker over here. So then I've looked at the mitigation. And then because we're doing it from a 1 hour, you're going to look on whatever time frame you prefer to look at, if it's 5 minute, 15 minute, 1 minute, or whatever the case is, and you are going to look for SMT. Because why? We know to sell because of the breaker. It's the same as the order block, right? When price trades into a 4-hour order block or a daily order block, we are anticipating a move against that, right? Right? It's the same concept here. The
Correct.
mitigation shows you that it has created a bearish or bullish mitigation or bearish or bullish breaker. Then as a byproduct of that, it no longer seeks the liquidity to that high or that low, and the structure told you it should sell, in this case sell, so that when price comes higher, it's likely to create SMT. How do you find SMT? Well, SMT on swing highs, SMTs on open, high, low, and close, SMT on mitigation, SMT on breaker. Do we see here that this blue line here represents mitigation on the 1 hour chart, right? And this blue line over here represents mitigation on GU. So when price created mitigation by trading through here, we would anticipate that, well, if the DXY is trading into the mitigation, a symmetrical move on the pound should be also a trade into mitigation, right?
Correct.
Correct, exactly.
Correct.
And then if you have confirmation like this, although this is not SMT here, right? That's not SMT, right?
Yeah, symmetrical.
There is still SMT though. So this is still just a turtle soup above an old high where you can enter a position.
Correct.
So Mud, often you ask me, where's the 1 minute confirmation? Well, the 1 minute confirmation is a move above an old high here that is still symmetrical on this 1 minute time frame, but not symmetrical on a 1 hour. So that is just a turtle soup sell model. Make sense?
Yeah.
No, sorry, I'm not getting it. This is how you say this is an asymmetrical move. This turtle soup of this high.
This is a symmetrical move on the 1 minute, right? We can see here that there's a swing low here and there's a swing high here. And on the 1 minute chart, both the pound and the dollar index grab the liquidity, right?
Yeah.
Yeah, same GU, same here.
But it's symmetrical on the 1 hour, sorry, on the 1 minute, but on the 1 hour where we found the mitigation, telling us it's a structure break, this is a turtle soup above an old high because the 1 hour is bearish.
Right. Okay. So it is symmetrical move on this time frame, but the mitigation. Okay, while doing that symmetrical move on Dixie, it has closed that symmetrical. Sorry, that mitigation block, whereas in GU it is not there. Is that what you are saying?
Yes.
Okay.
So you may
Correct.
have been looking on a lower time frame like a 1 minute for a non-symmetrical move, but you never got it because this was a symmetrical move here. But the
Yeah,
1
on
hour
the 1
is
hour
still bearish, and it's still SMT on the 1 hour, or if it was a 4 hour, for example.
mitigation SMT.
And you can also see, in addition to that, obviously we know that this purple line here was a 1 hour void on the dollar index, and there was a 1 hour void over here. But besides that, even if that void wasn't there, the mitigation is still there. The one mitigated, the one did not. That is non-symmetrical.
Yeah. DXY
So
is
that
doing.
any lower time frame price action, depending on what array you like to trade from, I personally like to trade old highs. You turtle soup an old high, regardless of if it's symmetrical on the 1 minute or not. The higher time frame is, bullish or bearish in this case.
But D in real time world, right? We always look for at 1 minute. I mean the same trade. If you change that time frame to 1 minute, and where you would have entered and where you would have kept your stop loss.
Well, entering would have been above this high over here.
That's what. So the high at 1 minute time frame, if say if that candles are not printed after that red, right? Only that green candle is found and the red is not printed at. How you would have entered the trade?
Well, you either execute, you put a limit, or you wait. So if you didn't sell the old high, then you would have had to wait for the order block, the void, or it returning back to close the void. So here you can actually see it closes this void here on GU,
okay.
but over here it doesn't.
It's not there. Yes.
And in addition to this, I have a yellow line on here, which is the opening price of the candle that is bearish candle on GU and a bullish candle on the DXY. So if price is below an open or above an open, that is a sign of bearishness or bullishness, depending on if you're trying to buy or sell. In this case, we're trying to sell, so we are trying to sell above an open. Okay, so I'm going to obviously leave it there for now. You guys can absorb this, go watch the other additional videos, and then I will take questions from all of you regarding this.
Cool.
But for now, just absorb
Thanks.
it.
Cool,
Okay.
Darren. Thanks, man. Awesome.
Okay.
Cheers, guys.
Thank
Have
you.
a nice one. Much appreciated.